We'll be getting started soon, and hopefully we'll have a recording show up. I'm trying to record this with both Camtasia and with the Zoom thing, so hopefully the recording will work. Anyway, good to see you folks here. We'll get underway in just a few minutes. Now, we will not have time for Q&A because we have a very fast-paced type of a format, with just 30 minutes per presenter. So we're going to hit the ground running. I urge you to follow up with the presenters individually if you have questions later, but we're not going to have time for that. Hey Mukesh, we'll have video in just a minute. Yeah, thanks all of you asking. We'll get underway. Let me turn control over to Steve so he can show his PowerPoint here. Okay, Steve, I am changing the host control over to you. So now you should be able to show your PowerPoint, and we'll get ready to get underway here in just a minute. All right, Steve. Hey, Steve. Yeah, we can see your PowerPoints. All right, good. Steve, are you there?
Sorry, I forgot to unmute myself. Yep. Let me know when to start, Ken.
Oh yeah. Yeah. Well, let's go ahead and get started. Let me introduce you, and we'll get underway. Hey.
Okay.
Hey everybody, welcome to our World's Top Traders Summit here for Saturday. It's a real honor to have so many of you here. Over 500 people registered for today, so you're to be congratulated on not being out there and shopping, but instead learning how to potentially make money instead of spending money. So leading off today is my longtime colleague Steve Nissen from candlecharts.com, the first and only person you should ever listen to when it comes to candles. Steve Nissen's the world's top authority on candlestick charts. So without further ado, Steve Nissen, take it away, and good to have you here.
Thank you, Ken. It's always a pleasure working with you. And the goal of the seminar is to make sure you use candles correctly. I had this cartoon made up. And the really sad part is these are my parents. So, but before we begin, let me give you our caveat. You're all going to be tested on this, so I have to read the whole thing. Obviously, just kidding. So the main point of this is, remember, there's a risk of loss of trading in any market in any time frame. If you have nothing else to do with your life, you can go to the disclosure, the link down here, and read the whole thing. So many of you are, I'm sure, very familiar with the essentials of candlestick charts. We're going to be going over some of the little ideas on how to use them more powerfully for your trading and investing. And just very briefly, for those who are halfway new to candles, remind you of the benefits. They're very easy to understand. I'm going to work on the assumption that you all know how to draw a candlestick line, what a green real body means, or white real body, or red real body, or black real body means, and what a doji is. I'll remind you a little bit later for those who are newer, but they're really easy to understand, but don't let the simplicity fool you. They're really, really powerful. Safety first trading, avoiding trades or investments, because at the end of the day, it's not how much you made, but how much you didn't lose. So we call that safety first trading. We're going to be looking at this very important aspect, Eastern, that is candlesticks with Western technicals. Very important to combine both. And just a reminder, candles work in all markets and all time frames. At my shop at candlecharts.com, we have students from over 85 countries. So keep in mind, whatever we do, it may not be your market. Some of the markets I actually hid because of the universality of candlesticks. So Ken, I could hear a little noise in the background, so maybe we could mute. Great, thank you. So with that in mind, I had mentioned that East and West. So we're going to look at that as one of our early and one of our tricks or tips, I should say. And the main thing is, I forgot to mention here that just came up, candles will give you early reversals. And this is particularly important whether you're trading outright or options. I'm going to have a little section here on options also. And they are the universal choice for traders and investors because you're going to get early reversal signals faster usually than Western technicals, because you think about it, most Western technical signals, they're lagging indicators. So moving averages, let's say you have a 20-day moving average, you have to average 20 days, stochastics, just about everything, trend lines. Now, it doesn't mean you don't use Western indicators with candles, but the first signs of reversals are almost always with candles. And we'll look at that in detail in this session. So what we call combining candlesticks with Western technicals is the multiplier effect. Really, really important. This is where a candle signal, and we call it a Nissen candle signal because there's so much free information on the internet about candlesticks since I revealed them to the Western world in the late 1980s, but a lot of it is wrong. So it's a real credit to you that you've come to this session, and I want to thank Ken for inviting me here to learn how to use candlesticks correctly, because it's really scary how many emails we get telling us about how incorrectly traders and investors use candles just from using the basic information on the internet. So we happen to call it Nissen candle signals, but really candlestick signals. So because candlesticks potentially call reversals, which is a high risk trade or investment, you're trying to call tops and bottoms, it is vital, in my opinion, to increase the likelihood of success to add candlesticks to your favorite Western indicators. We'll see examples. I like horizontal support and resistance. So I like to see a candle signal confirming it. So the idea is, at least, one of my trading principles, I have many trading principles, analyze what the candlestick line is telling us at support or resistance. Here is my research desk. I took this picture maybe 25, 30 years ago. These are all the candlestick books I had translated from Japanese to English. It cost me an absolute fortune. This is actually the English translations. These are all the pages in English of these books. And it took me a year to have the translator translate them and a year to put all the stuff together before I wrote my first book. But the reason I want to show you this is because all these books, although they're on candlesticks, they all had Western technical indicators. And so that behooves us to do the same thing the Japanese have been doing for over 100 years. So let's look at an example here. And again, it doesn't matter what market or what time frame. So here we had, some of you may recognize this as a bullish engulfing pattern where green candle wraps around a red wheel body during a downtrend. But even if it wasn't a reversal signal, this was a low for the move. So the market rallies. We happen to have a shooting star. Some of you may recognize this. But look what happened as the market pulled back. A bullish engulfing pattern, that is a green candle wrapping around a red wheel body, a potential bottom reversal signal. And to me, just as important, look what it's confirming. Forget about the fact that's another bullish engulfing pattern. It's an important low. So the theory is, and the way I would be trading this, if you were thinking of going long on this bullish engulfing pattern, I would be much more aggressive about doing that if it confirms a support area than I would if it did not confirm support. Now, I look at horizontal support or resistance. You may be looking at moving averages. You may be looking at a longer-term Fibonacci retracement as a support or resistance area. So the beauty of candlesticks is because it uses the same indicators as or the same data, open, high, low, and close. Any of your favorite Western indicators, I strongly advise you to continue using with candlesticks. Same thing here. Okay, a support area right over here. Now, more importantly, and this is an old Bitcoin chart, bearish engulfing pattern. Again, forget about the fact that it's a bearish reversal signal. Many of the candle signals can be used as support or resistance. The main thing to keep in mind here is that this was a high for the move. The market pulls back. We actually had another bottom reversal here with the candles. It rallies, and then we see a doji. A doji is telling us the market is tired. It's an equilibrium between the bulls and the bears. And equally significant beside the candlestick signal, look what it's confirming. And if you wanted more confirmation, you had a red wheel body. This is actually called an evening doji star. So a doji like this, I would probably not even pay much attention to it because, yes, it's telling us the market might be tired. And there's a lot of subtle variations in analyzing the candlestick we don't have time to get into today. But although there's a doji, this is a new high for the particular move, right? this is the highest close that the market's had since the bullish engulfing pattern. So normally I would wait for a bearish confirmation, which we got the next day, but because this doji confirmed a prior resistance area, this would be, to me, a negative signal. And when we talk about bearish signals, it doesn't mean go short. It's harder to short in equities than it is in other markets like Forex or options, but it would be a time to think about moving up stops or locking profits. So when we talk about bearish candlestick signals, it doesn't always mean going short. It means just protecting potential profits from the long side. Okay, here we have a couple of doji. We'll pull up doji or doji, but notice what's different. Here we have a doji. The RSI is not overbought, so I would ignore it. Here, the doji, the RSI is overbought, making the market more vulnerable. Again, a way of using candles with Western indicators. Okay, another example happened to be on a Forex to show you the universality. Here is a resistance area, a doji, and then a bearish engulfing pattern. So just some quick examples of showing the importance of combining candles with Western indicators. Okay. Now here's something interesting. Here we see the support area right over here, but using the insights of the candles. So here the market is moving south. What's happening to the red real bodies? They're getting smaller and smaller, right? So the market opened here, closed here, opened here, closed here, opened here, closed here. But as the market was moving down, even though this was a red real body, the bearish momentum was decreasing, and then ultimately we got a small green real body. So that is showing us that the bearish momentum is running out of steam, right at a support area, and again successfully defended at support right over here. Now, one of the things with candlesticks is that although they're great for reversals or potential reversals, candles do not give price targets. And that's another reason to strongly consider using Western technicals. One of my favorite measuring techniques, and that's why I use Western technicals very frequently, is a box range. So here, I'm a long-term chart, once again, to show you could use this in all time frames. A box range is what the Japanese call a lateral trading environment. So with a box range in traditional Western technicals, once you break out of the box range, either to the upside or the downside, you could take the height of the box range. And I'm being conservative here because it's a zone. Actually, this line should be down here. I'm just going from this one here rather than here. You take the height of the box range, and if it broke to the downside, you subtract this height. This would be $200. But here it broke out to the upside. So you would add the $200 to the breakout point and get a target of 1550. So keep in mind with measuring targets, whether you use breakouts or ascending triangles, it doesn't matter with Western technicals. A measurement doesn't mean it's the resistance area. It just means it's a potential target. But the reason I wanted to show you this particular slide is another reason to use Western technicals, not to have them confirm, not only to have them confirm Western candlestick, but to confirm or to use it as a measuring target. Now, I know many of you as students of Ken use intraday candles. And although most of my trading is on a daily chart, sometimes I'll look at a weekly chart. It's really neat to find what I call hidden support or resistance areas for those who have access to intraday trading. If you're at home and you're trading during the day, or even after that, if you go back on the chart, you may find using intraday hidden support or resistance. What do I mean by that? Let's look at this. So on this daily chart, okay, I think we'd all agree the first support would be down around 78, correct? That's a long way from here. It's like $4.50. So what I would do is go to an intraday. I normally don't go less than 30 or 60 minutes to see if I could find what I call hidden support or resistance area. So this is that April 15th, this long white candle. And some of my charts are green and red, and some of them are black and white. So I go to the intraday, April 15th. This is an intraday chart right over here. Do you see a support area in an intraday chart? Sure, look at this, 82. All right, you don't see that on the daily chart. So my first support would be around 82. And so then look what happened right around 82. And so if you were looking at a daily chart, you wouldn't have been able to see this. So what I would suggest, once again, is even if you don't trade intraday and you have something like this with a long white candle or green real body or a long black real body, and you want to get something early as potential support or resistance, look at an intraday. Same thing here. Hammer on the daily reversal, we get the reversal signal at 53, which is really far off the lows. But if you look at an intraday, look what happened on the intraday. On a 60-minute chart, we got a reversal. It happened to coincidentally be a hammer also at 49. So you got a reversal signal $4 higher thanks to the intraday chart. Okay, here's something we have daily updates on a member site. And one of the things I was looking at was Meta. And we could see there was some support right around, and I actually did the analysis on this day here, and we could see some support around 108. But it wasn't, you couldn't get a sense of how important it was. So what I did was I put an intraday chart on this day here, and look what happened, the hammer. Okay, so that's, and it was successfully defended over here, and look what happened after. So I'll use intraday quite often to get hidden support or resistance areas, or like the case here, early reversal signals. Now, many of you may trade options or may consider trading options. And what I'll be talking about here, even if you don't trade options, I think you'll get a lot out of it. The main thing with options, yes, implied volatility is important, but also important and more important is direction, getting the right direction. Trend direction blows away implied volatility. Far and away, the most important thing is direction. And just let me show you quickly how and why I say this. So let's hold, and this is something I did a little while ago. We're going to hold implied volatility constant at 26%, and we're going to push the price up over 30 days. Okay, theoretically, the Apple 300 call would go from 1270 to 6010. These are theoretical pricing. So we're holding implied volatility constant. Now what we're going to do is hold price constant and then push up implied volatility over 30 days. Look what happened. The 300 strike actually declined in value. Why is that? Obviously time value decay. But the important thing about this slide, and I know I'm going through it quickly, it's really for those who are option traders who understand implied volatility, is that a resultant price, it has multiple times the impact on option pricing than the change in implied volatility. Look at the change here. So vitally important. Yes, we always have to think about implied volatility, but we also must think about, is the trend direction changing? And that is going to be super important for your options trading. And beside that, why candles and options? Here's a nice example. So here we have, we're thinking about buying on the hammer over here. And what's nice about this hammer, it's confirming a prior low, correct? And just to refresh your memory, and I should have mentioned this before, hammer is a candlestick line with a long lower shadow after a downtrend. Lower shadow twice the height of the real body, small real body, black or white or green or red, depending on your charting system at the top end. So this is a classic hammer confirming support. So we consider buying on the hammer. The market is 395, and this theoretical pricing, 400 calls at 1130. Okay, now we're going to exit the doji here. Okay, 13 days after the hammer, so we lose a little time value. So we get a 320% return. Now, let's say we were not familiar with candles and hammers, and we were just using the MACD, which is really popular among a lot of option traders. So the MACD, and I'm not going to go into what it is, but essentially when it crosses over is a potential bullish signal. So you potentially buying on the crossover of the MACD over here. Okay. The market is up at 418. The 400 call is priced here. So we're exiting 5 days later, 1, 2, 3, 4, 5 at the doji. So we have a nice return, no problem with the return, 132%. But by getting in early with the hammer rather than waiting solely for the MACD, a Western signal, we generated over twice the profit. So a nice example of using candles to get early reversals, especially for options, but you could use this for any market, any time frame. Do you think this is a warning slide? As I said before, there are a lot of nuance, subtleties with candles. And one of them is, remember, candles don't predict what will happen in the next session. Just because you get a bullish candlestick signal doesn't mean that the market is going to reverse the next session. Here's a classic case. The market had a shooting star, and we got an email from a client who said, hey, the candles aren't working well. I sold on the shooting star and the market rallied. We got back to him. We said, this is a great shorting opportunity or a bearish signal. Why? It's a shooting star. And what is it confirming? A resistance area. And this is what happened after. So keep in mind, if you're doing a trade based on the candle signal, like the shooting star, let's say you're doing a bearish option trade, don't think the market's going to sell off immediately. Okay, it could rally. You just have to be comfortable getting out, having a stop above the shooting star. Okay, yeah, as we showed here, the candle line shows not only the price, but the force behind the move. Do this very quickly. Who's in charge here? Green real body, obviously the bulls. Bears are in charge. Who's in control here? With the doji, there's an equilibrium of forces between the bulls and the bears. So one of the things that you're going to learn as you delve into your education with candles is not all candlestick signals are equal. We have to look at market and context. So that's what we're going to look at now. So here we have a doji. Is this doji telling us there's something different about the market? Would you do anything with this doji? Okay, would you be nervous really? Not really, because here I'm showing a box range. So the doji is not showing us anything different. However, looking at a box range, what about this doji? Would you be trading this doji differently than that doji? Would you be trading the green doji differently? And hopefully you're all saying, at least mentally, of course you would be trading it differently. This doji is confirming a resistance area. This could be a potential great trade setup. Always have a protective stop. So I would have a stop above the resistance area. Remember, there's always a price that says you're wrong. And in this scenario, with the doji, I'd actually look for a return to the bottom end of the trading range. And you're going to find this when you continue your education, even with this short session, hopefully you're getting a little bit more depth about candlesticks. Just because you see a candlestick signal, it doesn't mean you're going to react the same with every appearance of that signal. It all depends on market context. Here's another example. Beautiful hammer, open up here, down here, closed right near the high. Beautiful hammer, but some of you may recognize this, a falling window. Okay. And a falling window is a potential resistance area, just like a rising window is support. So a falling window is resistance. And based on that, look what happened. So if you bought on this hammer, you would be buying right at resistance. One of the books I had translated phrased it very nicely. To know where you stand is as important as candle pattern recognition. Always keep that in mind. Okay, so here we have a gravestone doji. It sounds really ominous, doesn't it? And gravestone doji is essentially a shooting star, a very long upper shadow that has an open and closing at or near the low. And it sounds really ominous, but here again, we have, let me go back here, showing you the rising window as a potential support area. So we have a gravestone doji, and people will go online. unlike you who are really here to recognize the importance of continuing your education. They say, hey, gravestone doji, I saw on Google, it's a bearish signal, and oh my God, it sounds really negative. I see this gravestone doji, I'm going to get out of my long position or go short. But candles in context, there's a rising window here. This is a support area. So if you're selling here, you're selling right at support. In a scenario like this, I would wait for a close under the rising window. Okay, shooting star, same thing, rising window. Here is the bearish confirmation. Okay, really important, kind of finish up on this note here, because a lot of traders will forget about this. You can have a candlestick signal confirming a dozen Western signals. If you do not have a good risk reward, you don't do the trade. Okay. Risk, obviously, reward. What's your profit potential? As I alluded to before, candles do not give you targets. I'll look normally at recent highs and lows, but you're going to have to get a target based on however you analyze your markets. But candles are great for giving you the risk because you could set a protective stop using the candlestick signals. Let me show you a case in point. Here we got an email from one of our students. There was a bullish engulfing pattern here. He went long because it broke above a resistance area. See this falling resistance line? Trend line breakout. It confirmed a support area. Remember, I talked about how important support is. But what did he do wrong? He didn't look at risk reward. Because the mistake was, if you're buying it, and this green line, actually, the yellow line should be over here. Okay. If you're buying it here, and your target is there, so your risk reward, you're actually risking more than you are potentially making. I would step away from this trade. Okay. Your crossover resistance over here. Do we buy? What's the risk? What's the target? No, because if you're buying it here, because it closed over the rising falling window, if you're buying it here, the lower the hammer is your risk, and their target is over here. So it's a one-to-one risk reward. Okay. And one more, and I have a few on these because the risk reward aspect is something many, many traders forget about. So here is a box range. Okay, the market had a doji. Very often a candlestick signal is a resistance area. And we can, ignore all this stuff here. Look at it in detail in the video, but essentially the market closed over this resistance, but I would have this now as resistance. Our main focus is down here. Okay, here we have a bullish candlestick signal, right? A hammer. But this prior support, in theory, and I don't have time to get into it today, change of polarity, one of my favorite Western signals where all support becomes resistance. So based on this, one would not be buying unless it got above this level over here. Everybody see that? So yes, there's a hammer, but not a good risk reward in this scenario. And this is a nice way to kind of put it all together with risk reward. Which is a better signal to sell? And once again, when I say sell, it doesn't mean to go short. It means to think about lightening up on longs if you're long, fine to go short with options, depending on implied volatility and time value and so forth. And it's very easy to short in Forex. Remember, everything we talked about here can be used in all markets and all time frames. Which is a better signal to short? And the correct answer is, drum roll, we don't know. Why don't we know? Because we don't know where these candle signals are in context. A bearish engulfing pattern, this huge black real body wrapping around a small white real body, or shooting star. Now let me ask you, which is a better signal to short? Is it this bearish engulfing pattern, which we saw in the prior slide, or the shooting star? And hopefully you could quickly see it's the shooting star. If you sell, remember, we don't know it's a bearish engulfing pattern until the end of the session. If you sell it here, where's your risk? Up here, around 44.80. What's my target? Your target might be different. If your target was all the way at $36, it's a fine risk reward. But my target would be the most recent low. That's a really bad risk reward. So this is a potential trade I would step away from. Here, look at the risk reward here. If you're selling it here on the close, or even the next session's opening, your stop, I wouldn't move it. I wouldn't have the stop above here. I'd actually have it above today's high. And my target would be between here and here. That is a stellar risk reward. So this last part, really, really important, the aspect of risk reward, always consider that as part of your trading strategy. So with that in mind, just wrap it up just very quickly, give you our 1 or 2 minute education about or how to improve your education. Go to this link here, candlecharts.com bundle. It's what we call the bundle. There's 2 video sessions, all handouts are printable. You can look at this when you go to this link here. I don't want to spend time on it, all these bullet points here. But the main thing is, if you get the bundle, which combines the express class, which is basic candles, 3.5 hours, and advanced, rather than paying this, you're going to be getting the bundle, what we call the bundle, not for $295, which is a normal discount, but you're going to be getting it if you use, really important, use this coupon holiday. So you're going to be getting a 20% discount on it. And you're also going to get lifetime access to both of these 3.5 hour classes, which is a $98 value. And we give you a 30-day money back guarantee. More information about the guarantee is on this link at candlecharts.com/bundle. You can look at just some of the testimonials. This is only good for a very short time, so be sure to go to it. And any questions, ask Paul at candlecharts.com. And Ken, I have 30 seconds left. How do you like that for timing? Okay.
Perfect. Good timing. Great job. Yeah, great presentation too.
Thank you.
Yeah, outstanding. Yeah. All right. Well, thanks so much. Steve Nissen from candlecharts.com. Thank you. Can you hold on just a second here? Let me see if I can.
Right. And I want to congratulate everybody for taking the time to attend this. And thank you, Ken, again.
Yeah, thank you. It's a outstanding presentation. And what Steve teaches about risk reward is especially valuable because that's otherwise you use candles in isolation and that's not good. You need to put it in context of what's the money that you can be made versus the risk. So really good job. Let me see, I'm going to turn it over to Larry McMillan here. Just hold on just a second. Wanted to thank Steve for being here. Let's see. Steve, let me figure this out.
Okay. Well, I have enough stuff for another 5 hours if you want. I'll just pull up one of my full-day seminars. Yeah.
Yeah. Let's see.
Okay.
Steve, you might have to click stop sharing.
Wait,
me?
No, don't do that.
Don't do that. Okay. All right. A voice from above.
Yeah.
Stop sharing.
I'm trying to figure this out. I'm trying to.
How you doing, Larry? How you doing, Larry?
I'm good, Steve. How are you?
Good.
Okay. Now I've reclaimed host and I can turn it over to Larry McMillan, the world's top options expert. So thanks again, Steve, for being here. Really appreciate it, man.
My pleasure.
Outstanding presentation. Thanks so much.
Okay. Thanks.
And Larry McMillan, welcome aboard.
Thanks, Ken. How are you?
Doing great. How about yourself?
All right.
Let me change you over to the host and you should be able to get control right now and start your presentation. So, and again, thanks to all of you for being here. We had over 500 people registered and we got a really big turnout here, over 160 of you guys here. So thanks for being here. And thanks, Larry McMillan. I always learn a lot from you about the VIX too. So anyway, Larry McMillan, world's top options expert, take it away. And thanks so much for being here. Appreciate it.
Okay. You see that screen all right?
Yeah, it looks great. Yeah.
All right, great. So we're going to spend the next half hour just talking about what our option indicators say about the market. I would say as a general overview, we had some pretty bullish technical setups, but the Fed overruled that. And so we are in a more of a mixed picture right now. Anyway, our firm I started this firm over 30 years ago. We started out as a derivatives research firm, but then we moved into money management along the way. And we also do a certain amount of option education, option such as this seminar, but also mentoring as well. So I will come back to this later, but you will be able to download the PDF of this webinar And we also have a special deal on some of our newsletters. So these are the four main things that I look at. Of course, the chart of the S&P. Then we look at equity only put call ratios, which have been pretty interesting lately. We have a market breadth and we have an option twist on that. And then several indicators related to VIX. And also there's a seasonal pattern coming up as well. So there's a very important rule, and that is that oversold does not mean buy. So yesterday, with the market being down heavily for the second day in a row, we're already starting to see some oversold conditions. But in general, well, not in general, but always, oversold does not mean buy. We have to wait for a confirmed buy signal. An oversold market can continue to go down for a long time. You might think, well, that doesn't really happen this close to Christmas, but it did in 2018, so I'm not counting anything out. There's a related rule when the market is rising that overbought does not mean sell, and again, you have to wait for confirmed sell signals. So we really don't have any overbought conditions right now. So here's a 2-year chart of the S&P, and the main thing on this chart, of course, is the downtrend lines that are in place. The main downtrend line has been tested several times, including just a couple of weeks ago, and also at the beginning of the month, and it held both times. You can see the 200-day moving average is also in that same neighborhood. So that's a kind of formidable combination there. And if the bulls can get through that, then of course they could go for some resistance area, say like this one. But so far they haven't been able to do that. On the downside, we were pretty much testing this line, which is declining at a greater rate than the top line. We haven't touched this line in a while. If we were to go down here now, that would be a pretty big decline. Down. I'm not saying we're going to do that, but I'm just saying that's where the resistance or the support is. And also, this bear market at its worst was down 27% from the highs just last January. So the big picture is we're still in a bear market. That's what you should take from that. And those downtrend lines there are indicative of that. Here's a closer in view, zoomed in 1-year chart. The little green numbers there are how big the oversold rallies have been during this decline. And bear markets are marked with oversold rallies that look so good while they're happening and then just fade away eventually. So you can see that we just had a 600-point rally from the middle of October to, well, last week, right the day before. Well, the day the CPI was announced, the market rally then fell apart. So until that day, it was about 600 points from 3,500 to 4,100. So there's an old saying that no one makes money in a bear market because the bulls refuse to sell and the bears keep getting caught short on these big rallies like this. And there's some truth to that. I've marked some support levels here. You can see that this 3,900 had some credibility as a support level, and now we've broken that on Friday. I will say every person that I've seen has mentioned the 3,900 level, so it's not any secret. And sometimes when too many people are looking at the same thing, it doesn't really work out that way. But 4,100 is certainly a resistance. We've banged up against there twice and not been able to get through. And if the bears get rolling this week, we'll probably test 3,700. And then, of course, the yearly lows are at 3,500. I don't know if we could test those in just 1 week, but the 3,700 level is definitely in play right now. Another thing that we do is we draw Bollinger Bands on the S&P chart, and we trade a system based on those. The definition of volatility that we use is the same as Black and Scholes, which is slightly different than what John Bollinger uses in his classic Bollinger Bands. So we call them modified Bollinger Bands. And what we do is we look for the market to move outside these bands and then back in. That gives us a signal. So these red letters on the chart are all successful signals that have occurred in the past year. So for example, this top line right there, that's +4 standard deviations. And the line just inside of it is +3 standard deviations. So you can see here, we moved outside of 4 and inside of 3. That was the sell signal. And our target is the lower band, which we reached right there. So there's one blue letter here. That's a losing trade because we moved in there on the buy signal, and then before it could reach the upper band, it fell back outside again. But it did set up a nice buy signal down here in October. And this one, I'm basically declaring this one is over just because of its age being 2 months. It never did quite reach the upper bands, but we did certainly make some nice money on the bullish spreads we put on at that point in time. So we're waiting for a new setup there. You can see the bands have kind of contracted a bit recently. That's because realized volatility has declined with S&P being in this relatively tight range for almost a month. I mean, 200 points didn't used to be a tight range, but now it is a tight range. So the bands have moved inside. If we were to fall below the -4 standard deviation band right down here, that could set up another buy signal. So you can see that maybe if we tested 3,700, that might happen as well. So just to summarize, the trend of the market has been bearish since January of this year. And there's no reason to see that it has changed. So we haven't even broken through the first downtrend line yet. There's resistance at 4,100. That support we just broke yesterday at 3,900 is important, and there are several support levels below that. So our strategy basically has been to maintain a core bearish position, meaning put spreads on the S&P or on SPY because of the downtrend line on the S&P chart. And then we trade other longs around that if we get confirmed signals. We do have a subscription service if you like that concept of the McMillan volatility bands, where we look at every entity, all the stocks, futures, ETFs, indices, whatever, and send out an email every day with the signals on it. Anyway, let's move on to the next subject, put-call ratio. So put-call ratios are a contrary indicator. If too many people are buying puts, then the market is probably going to start going up pretty soon. If too many people are buying calls, the opposite occurs. Now, as far as predicting the broad stock market, we use what's called the equity-only put-call ratio. That's all stock options that trade. We measure them across all the option exchanges in the U.S. I think there's 8 or 9 of them now. But we just get a composite summary of them at the end of the day. The CBOE publishes their own ratio as well. I'll talk about that in a second. So again, as I said, it's a contrary indicator. And here's where what the chart looks like right now. This is just volume. So that's what I call the standard ratio. So the volume of puts divided by the volume of calls. Now, a local maximum on the chart is a buy signal for the stock market. And a local minimum on the chart is a sell signal for the stock market. So on the top here is the S&P chart, unscaled. And on the bottom is this equity-only standard put-call ratio using the options on all U.S. exchanges. There are millions of contracts that trade per day. So you can see we got a little local minimum here, but I put the sell signal over here because we use a computer analysis program to help us look at these charts, sort of like a chess tree playing program. And in this particular case, the computers were thinking this ratio is going to move lower, but when it hasn't moved lower in 10 days, that automatically qualifies as a sell signal. So a couple of weeks ago, this one rolled to a sell signal, and now you can see that it is moving higher. It will be going up here. Eventually, somewhere up there will form a local maximum for another buy signal. Now, when computers came in, we could do dollar weighted put-call ratios, and that's what this chart is. So rather than just the volume of the options, we're taking the volume times their price. And sometimes this gives us a more extreme view. For example, you can see this buy signal that came in October was at a fairly high level. What the number over here means, 240 means $240 in puts. We're trading for every $100 in calls. That's a huge number in terms of stock options. Anyway, so that was a buy signal. But now this also has rolled over just recently, formed this local minimum on the chart, and that's a sell signal. So as long as this is moving higher now, this indicator is on a sell signal. So both our put-call ratios are on sell signals at the current time. And historically, these have been very strong signals, more in the intermediate term nature, intermediate term by my definition, so they last like 2 or 3 months, something like that. I mentioned the equity only put call ratio and the CBOE. You probably don't follow that, but if you do, you might have noticed there's been several spikes in that recently. And after some long conversations with the CBOE, I'm convinced that those spikes are accurate. What's happening is somebody is trading a lot of, you know, index, stock options there. It's almost at the point, and there's some periods to it, like every 4 or 5 days. Perhaps there's a major program going on to just say continuously buy puts on the tech stocks or something like that. Never seen it act this way before, but the data I just showed you includes that, but it includes all the other exchanges as well. So what do we trade when we trade these things? So whenever I have a signal, I tend to use an in the money option to trade it. Slightly in the money, maybe with a delta of 70 or higher, because I'm trying to predict where the underlying is going. I don't want to buy an option that's not going to make money if my prediction is correct. So in this particular case, we're looking at those McMillan volatility band signals or the put call ratio signals. We'd be trading SPY options slightly in the money. If you're going out farther in time, you want to buy at the money, but still, even there, you have a delta of about 0.55. So on TV, and in our work too, you see it, but on TV, they almost always spread. That's really not the proper approach. But for some reason, they think it is. You should really only spread. And by spread, I mean, typically, if you had a buy signal, you would buy a call at this strike. Let's say the underlying is near that strike. You would not normally also sell a call out of the money. But that's what a spread is, a bull spread, and that cuts off your profit potential, as you can see. So the only time you should really do that is if options are expensive, and there's a proof for that, a mathematical proof of that. But the proponents of spreading will say, well, you're risking less, but you're not. You're risking 100% of the money that your broker requires you to put up if you're buying a spread or you're buying a call. So what would you rather have? This one that has potential to the upside, or this one which has the potential cut off? Obviously, you wouldn't be putting this on if you weren't bullish on the underlying to a certain extent. So if the options are expensive, we do spread them. Otherwise, most of the time, we do not spread. And if we do spread, there's a couple of things you can do to help yourself out. One is to widen the distance in the spread. So, for example, if you're buying SPY puts, maybe you saw the market breaking down yesterday and you think it's heading for that 3,700 level. You put on a put bear spread because VIX is still relatively high. Spread the strikes out like 25 to 40 points between the two strikes. That will help you out, give you some real distance. For calls, which are not as expensive, you only need to go maybe 13 to 15 points out. And then if you're right and the market moves and hits your short strike, which means you're just about out of profit potential at that point, roll the whole spread so that you add profit potential back in again. Anyway, just a couple individual put call charts. On these, I use only the extreme readings. So all these little local maximums in here and all that, those mean nothing. But this is Harley Davidson. We had an extreme reading last summer, which was a buy signal right here that worked pretty well. Then that quickly changed. That's pessimism on the market where everybody's buying puts. Quickly changed to optimism where everybody's buying calls. We got a local minimum, and that sort of halting fashion did work out. Now we've moved even lower and generated another sell signal. We saw this support level there, but once the support level was broken last week, we bought puts on Harley Davidson. Also, Akamai Tech, same sort of thing. You can see in the past, there's been a couple of sell signals from these really low levels here. This one, worked out all right. This one worked out even better. And now we're getting a new one here. So people were very optimistic. I'm not sure why, but we're buying a lot of calls. And now that situation has reversed and we have a local minimum on the put call ratio chart, which is a sell signal. And then just one more PACCAR. This is some decent both buy and sell signals in the past. And again, we had a very extreme one here at the 30 level, which means that only $30 are being spent on puts for every $100 being spent on calls. That's not very much for individual stock. And you can see it's already starting to break down, making a series of lower lows and lower highs. So we're also buying puts on that. All right, the next topic is market breadth, and there's a couple of things you can do with breadth. One, you can just keep under a total of it, and number two, you can keep an oscillator. The question is, what breadth do you use? The New York Stock Exchange, of course, is the most popular one to use, but the New York Stock Exchange includes things that aren't stocks in its breadth. So we try to use a stocks only breadth indicator. And so we use all optionable stocks. It's a big data set. It's over 6,000 stocks have options now. And so we can do our advanced decline numbers and everything on the stocks, on the optionable stocks. So this is the oscillator that we created using stocks only data. And this particular chart goes all the way back to 2013. For a great deal of that time, we were in a bull market, really all the way up to the beginning of this year. So we did the oversold is the green areas, and we didn't get oversold too many times. That's really kind of the beginning of this year's about in there. We did have that very bad sell-off in 2018, right before Christmas. So and that was it was saying it is possible to have these very nasty sell-offs right before Christmas. And of course, then we had one in March 2020 with the pandemic panic. And so, but now a couple of times this year, we almost reached those same levels. But as I said, oversold does not mean buy. We wait for it to stop being oversold, and then we buy. So one of these classic ones here is that came back out in January of 2019, came back out, and look how overbought it then got. But that was actually a show of power at that point, and the market took off to the upside. So here, most recently, we had this long oversold condition all summer. And then we finally got a buy signal there, which was near, the lows. And as you saw, we on some of the other charts, we have other buy signals as well. But now things are starting to falter. We moved out of overbought into a sell signal on December 5th. And now just yesterday, we moved into oversold territory. So again, as I said earlier, breadth indicators are oversold, but that does not mean buy. We need to see how deeply oversold this is going to be, and then for it to stop being oversold before we can get a buy signal there. So that just sort of summarizes, I guess, what I just said. We also keep a pretty close watch on new highs versus new lows, and the bottom line here, this thing has been on a sell signal since April, and it still is. It almost came out of it, and as I said, we were getting some positive indicators in the early part of December, but then they sort of failed, and then the Fed, threw cold water on everything, and so we did not get some of those buy signals. But this has it was a good warning sign back in April, because or even as far back as January, because we were already starting to get a lot of new lows. And yet the market was just really very close, the market being the S&P, very close to its all-time high. So something like that is a negative divergence, and we don't have those right now. The type what we're probably looking for now more is a positive divergence. We don't have that either. But anyway, the new highs versus new low indicator is still bearish. So this brings us to VIX, and we do a couple of things with VIX. First of all, the trend of VIX is very important. So if VIX is trending higher, the market's 75% of the time going lower. And if VIX is trending lower, 75% of the time, market's going higher. We also watch for spike peaks in VIX, because that's generally a sign that the market, people have panicked. They bought, heavily rushed in to pay, perhaps overpay for S&P 500 puts. And the S&P 500 options are what creates VIX, so it's behind VIX. And so we look at those for buy signals. So this is a chart of the S&P going back 1 year. All those B's on there are a system, that we set up to trade the VIX spike peak buy signal. So the red and orange signals are positive trades, and the blue signals are losing trades. We have a stop on these systems, and so they're over time. This has an extremely good track record. It's been one of our best indicators, but they all have, their problems. And as I believe Steve was saying earlier, you have to have a stop out price. Anyway, we had this nice buy signal here in October. We rode that pretty much all the way up. And now we've just had another buy signal. But, and you can't pick and choose which ones you're going to take. So we took it. But to me, yesterday I wrote an entire article about this because I think it was sort of a fake move the way VIX is calculated. Some very expensive options in January came within the VIX calculation. It made VIX spike up on the day that the market was up. So you had VIX up a lot, you had the market up a lot. That doesn't happen. In fact, to that magnitude, it hadn't happened since 1997. And after that, it's really no particular indicator, but it did create this sort of artificial VIX spike peak, but it is a spike peak, so can't argue with that. I also talked about the trend of VIX. Right here, the 20-day moving average, which is this guy, crossed below the 200-day moving average, and VIX itself was also below the 200-day. So by our definition, that means VIX is trending downwards, and that is a VIX trend of VIX buy signal. You can see back here, that was the opposite. We had a trend of VIX sell signal, which was pretty operative, and we've had a couple of those earlier in the year too. In fact, we got one trend of VIX sell signal all the way back in January, was not reversed until here. So all of that time, the trend of VIX was bearish. Now the trend of VIX is bullish, and is one of the things that makes me think this market is not just going to collapse here, even though some people are starting to say that. So just to summarize, we have this VIX spike peak buy signal. I say it's a bit suspicious, but it still counts. I mean, if you're a technician, you have to take your signals. You can't go back and say, oh, well, I'm not going to take this and for some superfluous reason. Anyway, so the VIX indicators are relatively positive, but we can't trade VIX. But we can trade the VIX futures. So they can give us some clues too, VIX futures and options. In a bull market, the term structure of the VIX futures slopes upwards, as you see in this chart. In a bear market, the term structure slopes downwards, as in this chart, which we certainly saw that heavily in March of 2020. So where are we right now? Here's last night's closing prices. Now, December VIX futures are going to expire next week, on the 21st, but they're still in play right now. So VIX closed at 22.62, and the VIX futures, the near-term ones, closed at 22.56 on Friday. So the premium, in this case, actually a discount, is a 6-cent discount. But you can see the other futures. You'll see the term structure sloping upwards. Each one is higher priced than the one preceding it, and they all have a pretty good premium on them. So this is, again, another bullish picture we're getting from the VIX derivatives. If you're not looking at VIX futures, you can look at the CBOE volatility indices. There's 5 of those, a 9-day, 30. This 9-day went wild before the CPI, but that settled back down again. And you can see, again, these all slope upwards in price. So again, bullish. So these are another set of slightly bullish indicators. So VIX is pretty bullish. Now we would get a huge negative sign if the February futures suddenly were surpassed in price by the January future. That's VIX futures. Currently it's 95 cents Feb over Jan, and that's good. The reason I'm not counting December in there is it's just about to expire. It would have to settle negative $1. In other words, January would have to rise to be higher in price over February by more than $1. Now, we saw that kind of thing back in 2020 in that bear market. We've not seen it very much in this one. So it's a warning sign that, doesn't have to be in place for the market to decline. So I mentioned a seasonal pattern. There's one coming up here. It's the Santa Claus rally, invented by Yale Hirsch about 60 years ago. And the theory is that the market rises over the last 5 trading days of one year and the first 2 trading days of the next. It has a pretty good track record. If you look at Stock Traders Almanac, which is published by the Hirsch organization. Well, I think they actually sold it to Wiley now, but still has all the data in there. So this year, that would mean buy at the close of trading on Thursday, December 22nd, and hold for 7 trading days. There is a caveat that when this Yale Hirsch wrote it in the beginning, I understand that he considers himself to be something of a lyricist, so that's he liked to write things like this. If Santa Claus should fail to call, bears may come to Broad Wall. In other words, if you don't get this rally, it has often been a very negative indicator for the stock market. So it'll definitely be worth paying attention. Summarizing our indicators on the left side, you can see that we have 3 volatility indicators that are positive, including and the Santa Claus rally. On the bearish side, over on the right, we've got the chart of the S&P, the equity only put call ratios, and the new highs versus new lows. And in the middle, red oscillators are still on a sell signal, although they're oversold. So to me, this is a mixed picture, but if you discount the VIX indicators, it's a much more bearish picture. So VIX has sort of been in a world of its own this year. But right now it's sort of saying that things aren't as bad as you might think they are. But, breaking that 3,900 level on Friday, to me, was quite serious. So we are still maintaining, as I said, a core bearish position. We will trade other buy signals around that. Now, I compared this market to the 73, 74 bear market many times, and it lasted about 2 years. It started in January of 73, didn't bottom till October of 74. I think there's a really good chance this market's the same way. It started in January of 22, doesn't bottom until next October. October is known as the bear killer month. Certainly was in that case. Inflation was a big problem back then. In fact, there were the 3 I's: inflation, interest rate, and impeachment. We don't have impeachment right now, but we certainly have the other 2. And, it's a problem for the market. And inflation went on many years after that. The market just bottomed. So where are we right now, in my opinion? Right there. We had this big rally, and now it's failing. And we're still above the lows. And it took a while. It's played around there for a while, but eventually started down heavily again the next spring and summer. So we'll see. But so far, it's kind of been playing out that way. So as I said, if you visit this website, you can download the PDF of this webinar. And there's a couple of deals that we have there for some of our products. We also have a YouTube channel and a couple of other newsletters. So visit our website, visit that link, and kick the tires. You'll probably find something there of interest, and it won't be too expensive. So Ken, let me shoot it back to you.
All right. Well, Larry, thanks for an outstanding presentation. I really appreciate it. Always good to see experts at work here and trying to. Can you stop sharing for a second and let me see if I can reclaim the host control?
Yep.
Okay, now let me see if I can switch it over to Bennett. But yeah, outstanding presentation. Really appreciate it.
Okay. Glad to do it.
You could hold on just a minute here. Let's see, I'm still learning how to use the Zoom controls. Okay, here we go. So now I should be able to reclaim host. All right, and
hey Ken, while you're doing that, let me just test the audio. Can you hear me?
Yeah, I can hear you fine. Let me switch over to you. Okay. And we should be ready to go with Bennett McDowell. And thanks, Bennett, for being here. It's great to have such an all-star lineup of really credible, helpful, intelligent people here to help all the traders. We got over 500 folks that registered and 200 here live, so it's good to see an epic turnout. Let me switch this over and make host. And you should be ready to go. So thanks, Bennett McDowell, for being here. Appreciate it. And thanks to all the traders for being here. We had a really big turnout, so y'all are to be congratulated for being here. And Bennett, you can take it away.
Okay. Do you hear me?
Yeah, looks, I can hear and see you. You're
Okay,
in great
great.
shape. Thanks.
Okay, good. We're good to go then. Well, Ken, thanks so much for having me today. And, it's great to be with both Steve and Larry again. It's been years since we've really done something together all together. So really
Right.
super. Good job putting it together.
Well, thanks. Well, good. It's an honor to have really smart people because there's so much junk out there on YouTube. I want to create, my vision for World's Top Traders is to have World's Top Traders, people actually know what they're talking about, who can actually be of help to traders. So thanks for being here, and welcome aboard, Bennett. Good to have you here, man.
Well, my pleasure. My pleasure. All right. Well, today I'm going to talk, Ken, about basically multiple time frame analysis. And, each trader has their own unique way of entering the market. But what I want to share here is how you can actually apply that to different time frames to even increase their probabilities. And so we're going to talk a little bit about that. And of course, I have to go through, of course, the disclaimers, like I think every speaker needs to do these days. But there is risk in trading the financial markets. Like I always say, without that risk, there is no opportunity. So the two really go hand in hand. Make sure you're trading with risk capital. And of course, talk to your money manager or financial planner before actually executing any trades. And then finally, know how to do risk control. And this is kind of interesting. So we have Steve here, and Steve wrote the foreword to my book on the far left called The Trader's Money Management System. And Larry wrote the foreword to The Art of Trading right next to it. And those books both came out in 2008. And boy, I don't know where the time went, but boy, did it fly. But I also have a new book coming out, The Art of Trading, second edition. Our publisher asked me to do one of those for next year. So that's coming out. And the book I want to really emphasize today is the book second to the right called A Money Management for Traders. It's very difficult in this business to be profitable. I would say almost impossible without good risk control on each trade, because you never know what trade is going to be really good and what trade is going to fail. I can't tell you how many trades I think, oh boy, this is really going to be a good one. And what do? I get stopped out. So you have to use good risk control on every trade. And that book is an easy read. And what I've done is I basically have stripped down the important elements in my more comprehensive book on the far left and put it into this book. So if you're looking for a good sound risk control that's easily to implicate into your trading, that's the book for you. So definitely check it out. All right, we're going to be looking at charts. I have a whole bunch of software. I'm not really going to go into this, but we have charting software, scanning software, and of course, risk control software available on our website. And you can go there if you're interested and check that out. You'll be seeing some charts where I have that available today. Now, the other interesting thing is we also have a YouTube channel. And every Friday, I do what we call Stock Analysis Fridays. And I want to invite everybody there because it's kind of an interesting form. It's free, and we look at live markets on Friday. It's 8 a.m. Pacific time every Friday, unless it's a holiday, of course. But what we do is if you have a stock you want a second opinion on, join us. All right, I'll be glad to look it up using multiple time frame analysis, which I'm going to show you today, along with our trading tools. And then also, too, what is really interesting about this room that we didn't really plan on is it turned out to almost be like a stock picking room, because everybody that comes brings a few stocks. And by the time you leave, you may pick up a few new ones. So it's kind of, we didn't really anticipate that really occurring, but it has. And so it's kind of cool. So definitely check us out. And you can get there by, again, going to our website and just clicking on the YouTube. And finally, thank you for attending today. So it's great to be here. All right, so let me just exit out of here and go into charts. Now, I happen to be using NinjaTrader here. These are our scanners running up here. But what I want to focus on today is the fact that notice I have 3 symbols, all of the same chart. And the chart on the left, this would be for position trading. The chart on the left is a short-term aspect of that symbol. And this is a 60-minute chart. So we call that the short-term aspect. The chart in the center is the daily chart. This is the intermediate. And then the weekly chart is our long-term look on the market. But it's all the same symbol. And so no matter what trading system you're using, you can do this as soon as you leave this webinar today. And basically the rule for this, if you're a position trader, you can start with a 60-minute and set it up just exactly what I have here, but you want to have at least 5 time frames in between the charts. So that's really important. And then it's a matter of connecting the dots. So think about when you first started trading, you probably used one chart and you became proficient with your trading approach. And that's all you have to do is magnify that 3 times, and it will give you a much better look at the stock you're looking at and a better possible entry as well. So for example, if you're day trading, let me just go to the day trading timeframes. You know, we run a day trading room as well. On the day trading timeframes, we have, for example, very short intraday timeframes we use for this, but it's the same concept. So we have here a 15-second, we have a 1 minute, and we have a 5 minute. And the funny thing is people say, oh my gosh, you trade a 1 minute, you must be really going at it. Not really. There's a lot of times where I'm waiting for the correct setup. And when you're using 3 time frames, sometimes you have to wait a half an hour, if not more, for the right setup. But I know when the setup comes and I start connecting the dots and more dots line up, then it's time to pull the trigger, and that increases the probability of the trade. So you can use this whether you're a day trader or a position trader. And this is exactly what we do during our YouTube sessions on Friday when you bring a symbol. So what I'd like everybody to do, and Larry, Ken, I think, is there a place where I can see, I don't see the chat area. What I'd like to do is be able to see chats or have maybe you come on. If anybody wants to type in a symbol, type it in caps for me, and I'll be glad to look it up and analyze it. I'm going to start out with MRVL here. And on Marvel here, this is the weekly time frame. So one of the dots I like to connect right away is the Elliott wave. So when I look at this chart here, I can see that this is a major wave 3. Now, these indicators you're not going to probably have on your chart unless you're using our system here. This is the OWL, this is the PTF, and these all tell me something. So I'm really not going to go into too much detail on how they work or anything. What I instead want to do is impart on you that no matter what trading system you're using, if you become proficient in figuring out basically high probability trades using your approach on one time frame, you do it on all time frames. So for me, using the Elliott wave, I like to see where we are. Elliott wave is a good roadmap of the markets for me. And I've been using it for a long time, and I'm very used to using it. And so the first dot I like to connect is I like to see a clear pattern up on the Elliott wave. That's a 3, okay? Then I like to look at the OWL and see if that agrees with price. And if it does, that's a dot connected. Then I like to see if we've had a retracement after, and we have. And then I draw the fibs in between waves 2 and 3. And then I take a look and see if we hit the target zone. And that's another dot connected. Then I take a look and see if this indicator here, again, we call this the OWL, has negative momentum. You have to have negative momentum in order for that to be a wave 4. So that works. Now it's still red. And then the other indicator I take a look at is this. Now that wave 3, this doesn't always happen, but it did in this case. That wave 3 triggered a green colored PTF. And so that PTF is saying there's a 75% probability that we will eventually return and take that high out. So after wave 4, that would make sense for a wave 5 top. For those of you that are into Elliott wave, there are 5 waves in a trend, with the 5th wave being higher than wave 3, but it usually occurs on less enthusiasm, thus less volume, thus less momentum. So this is kind of clear. All right, now I've just got to make sure I don't go in too early and make sure that it's time to pull the trigger or wait still. And for this, I go to the lower time frames. So then I take a look at this time frame here. So this also has a green PTF indicator here. So that's in sync with here. So this thing should return and make higher highs, but we have a bearish pyramid here. And we also have bearishness on our 60-minute chart. So it's still going down. So the bottom may or may not be in, but you don't want to go long here. Now, if I didn't have these lower time frames I was looking at, okay, I may be more apt to say, okay, we hit the target zone, time to go in. But you don't want to do that. If you use multiple time frame analysis, you can kind of time it a lot better. And again, This is my approach. Everybody out there probably has their own type of approach. But if you can actually look at the 3 different time frames, don't you think that one might help you actually increase the odds of getting a better price when you enter? All right, so that's just an example, and it's a good one of using multiple time frame analysis. Let's take a look, for example, at NVIDIA here. And I can't see the chat, so I have no idea if you're typing anything in. So I'm just going to go ahead. I've got enough symbols to take us through the half an hour. And then you can join us on our YouTube channel on Friday if you want me to look at your stocks. All right, so here's NVIDIA, same type of thing. All right, pretty clear. Big move out. You have an Elliott wave 1, 2, 3, okay, 4, kind of deep. So on the Elliott wave retracements, what we do is draw our fib retracements between wave 2 and wave 3. And usually if they get to this area here, that happens 70% of the time. If they get a little bit more extended, that's 15% of the time. And if they get a little shallow, it's 15% of the time. So as long as they don't go above wave 1 or into the top of wave 1, technically that can still be a wave 4. So this again, all right, kind of clear, a little deeper retracement that I would have liked at first, but now we have green here and green here. So it's basically saying we should get above that high there. So let's take a look at the lower time frames. And certainly we've got the daily showing that big move up. And now we've got a move down. You can see it here, but amplified over here on the 60-minute chart. So would you pull the trigger here based on multiple time frame analysis? I would wait until this owl here turns green because it's still pulling back. And if you draw in the point of inflection of the possible pullback, you're talking about a range probably around 157 to 138. So I wouldn't be surprised if we get in there for that. Okay. All right, so I got some stocks coming in. My wife just ran in with a couple here, so I'll look those up in just a minute. All right, so in this case here, I would hold off. But again, if I wasn't using multiple time frame analysis, I might not have this information that's pretty vital on the lower time frame for me to help me make that assessment. And so I would wait for this to pull back. And if it doesn't quite reach the target zone at the time, then I would go long even if it turns green, all right, and put my stop as low as I possibly could along the bottom. All right, so that's NVIDIA, okay, so that's another one. All right, John is with us today, and he would like me to look at OXY, so let's type that in. And let's give that a second to load. All right, let's open up that weekly chart and see if where we are in this. All right, so we had a really big pullback. This is not a wave 4, even though this might have looked like a wave 3 at some point. This has gone all the way down to the bottom. So maybe a large wave 1, maybe a large wave 2, which could be why you're getting this very enthusiastic move to the upside. All right, so I don't know if you're currently long. I hope you are, okay? However, is it still a good idea to go in now? Well, let's look at the lower time frames. And the answer to that probably is not, because we're going into a pullback. So what we're saying is maybe we'll come down to a point of inflection, John, right around the $50 mark or into the upper 40s, and then may get a rebound. But for right now, according to the studies that I use, here we got a bearish pyramid here. And pyramids basically are nothing but looking at fractal patterns and trend trading patterns in the market. So that's bearish. We got a bearish owl, so the momentum is bearish. This is bearish. All right, so there's nothing very bullish on the lower time frames. So it's still coming down, so I would not be a buyer here. But let's take a look and see, all right, maybe how far this thing could come down for an inflection point. And we can either use this time frame or even the weekly at this point, because they'd be pretty much the same. So probably I would say around $50 to about $34. So that's a dot that I would like connected. before I get serious about a long trade. And then the other dots have to align themselves as well, okay? So that's kind of one of those that could be good in a little while, but not yet. So you put it on a watch list, all right? The next one is BAH, and this is from Bill. Hi, Bill. All right, let's see what we got cooking on this. Again, start with the higher time frame. All right, nice move up, very, very nice move up. Now, what's interesting about this is notice that the owl is indicating a wave 3 here. So this is still in a 3. And we know after a 3, what do we get? A wave 4, right? And then we get the wave 5. All right, so I would expect some type of correction on this. According to this, it's a little too early to say the correction's begun, because look how strong the wave 3 momentum still is. But, you know, this is premature, but I'll draw them in anyway, and we can keep moving them if we have to. So let's go ahead and take a look at where a fib retracement would be here. Notice I did not draw the fibs all the way down at the bottom. All right, I pretty much picked what I determined to be a wave 2 area to draw those fibs in to get the accuracy of the pullback. But in any case here, this thing could come down when it does get ready to correct in this particular target range between 76 and 53. All right, now let's take a look at the lower time frames and see if we're, you know, at a top or not. All right, well, this is showing the pullback a little bit, but check this out. We have a green PTF here on the 60-minute time frame showing one more high. All right, so I can't go short with this being green. So because of the 60-minute time frame, it's saying we probably will get one more high before it sells off. So that would keep me out of a short trade down to the fib target zone. And it would also probably maybe warrant a quick long trade here, but I don't like chasing trends. So I probably would pass on this and go for something else. So if you're long on this, all right, you probably could stay long at this particular point, but maybe have your stop under this pyramid here on the weekly chart. And then when the weekly wave 3 is over and the other time frames at that time turn more bearish, then exit the trade. All right, let's see. Let's take a look at gold here. I got a whole bunch coming in here, which is great. All right, so gold is one. Let's take a look at this long-term time frame here. And notice here, if we go back to 2011, which is over in here, this was wave 3, okay? Then we had a wave 4, and now here's our wave 5 target. All right, so that's where we're heading up on gold. So gold's got some more highs in here. We had to wait quite a while to get into this because we had a top here right next to the target, but the PTF said at that particular point, wave 5 was not over. And of course, 75% probability is not 100. So you always have to use risk control. This was a major bottom that occurred back in 2015. All right, and now we're heading on up, it looks like, to another target here, but let's check the lower time frames to make sure this could be a good possible bottom. And of course, I already know the answer because we have recommended this one already. And notice that on the lower time frames here during this move up, all right, we were green and we were green here. So that was a long trade. Now, here's the issue with this. If you're thinking about going long now, you have the green here, but you don't have it here. So wait for this to turn green. This is a 60-minute chart. So if you wait and you're trying to get way up here, don't worry about missing out on a day or two, because you want to make sure the downdraft is over before going in. And you've got plenty of risk to reward. All right, even if you put your stop at the bottom, you got a 2-to-1 into the target zone. So you're good here. So what I would do here is if you're not long, wait until the momentum gets a little more bullish on the 60-minute chart. Or if you want to, then your decision is where are you going to put the stop? All right, do you put it at the bottom? Do you put it here? On the first breakout from a bottom, always put your stop at the bottom, because usually you can get a retracement after that that's pretty nasty, that will stop you out if you have your stop too close. Now, if the market is so far away from the bottom by the time you find it, and the stop doesn't make sense because, you know, maybe it'll only yield 5 shares or something, depending on your account size, then this is where you can step in and use options. Okay. And options are a great way because, for example, if you want to control it, there's many ways you can control your risk with options. And Larry is a pro on that. But for example, you could just simply take 2% of your account size and just don't buy any more than 2% of a call. That way, if the call expires worthless, you lose 2%, but at least you've got more leverage than you would have if you probably bought the underlying asset, and you can check and see before you make the trade. So gold is good. All right. Gold's pulling back a teeny bit right now. So just kind of hang tight on that. All right. Disney. Let's take a look at Disney. And this is for Leland. All right. All right. Disney's tumbled, right? Definitely has come down. Let's take a look at that weekly chart first. Nice wave 3. Done. Okay. And notice we have the wave 4 owl. We have a fairly clear wave 3. Here's your COVID low. Okay. And then popped up. So where are we now? All right. Well, first dot we need to connect is we got to see where we are in terms of the correction. Okay. We're there. So basically I'm calling this a 1, this high here, this low here, 2, 3. So we're not into the wave 1 area. So this could still be a wave 4. We got an active pyramid and an active bearish owl on the long term. So that's bearish still, even though it hit the target zone. So one dot connected, but not the others. The other dot that's connected, it's clear. Okay, that's a clear Elliott wave 3 at this point. All right, so now we look at the lower time frames, and you can certainly see we have an active fractal to the downside or pyramid to the downside here. All right, we have a red PTF here, no longer red here. That's a good sign, but we do have one here. So it looks like we're going to go down a little bit lower. And let's see if that is, let me just take a look at a little more history on that. Yeah, that is quite not the low here. Let me just grab a horizontal line real quick. Where is that horizontal? There it is. Okay, put it there. So we have not taken out the bottom yet. So this PTF is not necessarily saying we'll make a new bottom. It's just saying this is the low that created it. Okay, so we're going lower than that. Then we're going to see if that bottom holds. Now, if the bottom holds and we get a turnaround, then that's a good sign. But for right now, you don't want to go long. We do have bullish divergence building. Okay, especially if that makes it, yeah, it's bullish because that made a new low there. Okay, so that's good. All right, so I would wait on this one. Hopefully you're not in it. If you are, you're going to have to, you've experienced some discomfort lately, so I hope that's not the case. But if you're thinking about going in it, you want to wait. All right, just wait a little while. IRM. Well, you guys are having a lot of lists. This is excellent. All right, let's take a look at IRM, and this is for Barry. Hi, Barry. All right, so on IRM, okay, we've got, let's take a look at that weekly first real quick. Kind of messy, right? But let's take a look at the longer aspect. Looks like it goes back to 2000. Not a very exciting stock. So right away, not so great. I will say, however, that it had a long channel here and it has broken out of the channel. Okay, so that means something. Possibly a beginning of a move out, maybe a 1, but then you're going to have a nasty 2. Let's see if the short-term charts are yielding anything. No. Okay. If anything here, notice this top held and now we're moving down. Okay. So we've got a red PTF here. So I wouldn't do anything with it. If you wanted to consider shorting, I'd have to wait until this pyramid is taken out here. And then you have to figure out where the possible target zone is. And the best thing I can do for a target zone is maybe an inflection point there. And so I'm not so sure a short trade makes sense there. So I would probably pass on this one. All right. If you're in it, make sure you have a stop set because you may need it. All right. Netflix. Good one. NFLX. All right. So Netflix, here's a little issue with Netflix here. Big move up. Okay. Nice retracement, but a deep retracement. So let's go ahead and take a quick look at that. Give me a second. Just draw that real quick. All right, so could wave 4, but that's an awful deep one. Okay. That's suspicious. But the nice thing is if it's a wave 2 and it's over, or if it's a wave 4, they both result in the next move being bullish. The only problem I have with this is this bad boy down here. Okay. It's saying that this is not over. So this may go into a deeper dive. And if that's the case, it may be a 2. All right. So no go in terms of that. All right. So the only possibility here is the retracement maybe going short if we get up here. Notice this is red. This is red, this is red. So no long position here at all. Maybe a short position if we get up here to take it down here, because this could be a 3, a 4, and a 5 with inside C wave or whatever wave that is in the correction, okay? So I would kind of, at this point, just not be long on that. I don't think I would be short yet because you still have a green owl on the daily chart. All right, let me keep going here. DX. Hopefully you guys like this. I only got a couple minutes left here, so I don't think I can get to all of them. I'll do one more after this. So on DXC, and this is for William. All right, so we had a big move down. History goes back to about 2017-ish. We got kind of a moderate basing here. Let's just take a quick look and see. You know, as you can see, a big dot I use as fib. So we did hit the fib zone here. So that's kind of interesting. You did have a wave 4 owl to the bullish side. The question is it going to go back into the target and be a complex correction, or is it going to just fall from here? Now, this is kind of interesting because you have a green PTF here indicating we're going back up before it goes down. So I wouldn't go short here. Okay. So not my favorite on that one. So I'd kind of be careful on that one. And then the last one is, let's take a look at MR. I think I actually looked at that one. Let's take a look at GERN. Okay, and this will be the final one because we got to wrap it up here. All right, so GERN, notice we had a big move down on the weekly. Okay, boom, we're flatlining, bottoming. No PTF to help us, but we do have a green owl. But if we look on the daily chart here, okay, we have a situation where we did retrace to the target zone. We got a green, we got a pyramid, and there's the fib target zone for wave 5. So we go 3, 4, 5 up there, short term. So you got the risk to reward. If you put the stop at the bottom, put here, you got 2 to 1 into the target zone. You have to calculate your trade size, but we have a red owl. So wait a little bit before going. Don't forget, this is a 60-minute chart, so this can change.
All right, good presentation, Bennett. Thanks. We got to
Yes,
wrap up
I'm
now,
done.
but thanks so much. That was outstanding. Really good multi-timeframe analysis. I was impressed with your technicals. Any last thoughts or a website link to send them to?
Oh, no, that's it. That's it. Just come to our YouTube page on Friday, because this is exactly the kind of stuff we do, and you'll pick up a few stocks.
Well, that sounds good. Now, if you could, hold on just a second. I see there's a reclaim host button. Great.
Ken, thank you.
Well, thank you for being here, man. Yeah, you were outstanding presentation. I really enjoyed it.
Thanks, everybody. Bye-bye.
Thanks, everyone. Thanks. All right. Well, next up, we have Oscar coming up in just a second. Let me see if I can make Oscar the presenter. And thanks, everyone, for being here. A really good turnout. We got Oscar and then Marina and then myself. Everybody having a good time. I like this half-hour format. What do you guys think? Has this been a good format for us with just 30 minutes instead of, that way we can hit the ground running and do things quickly. Let me change this over to Oscar. And Oscar, now you should have ability to take control and show us your screen and broadcast. So welcome aboard.
All right, let's see what we can do. Share screen, that should be me.
I can hear you just fine, so that's good.
Me. Excellent. So you
And
can
you're-
hear me, and I'm going to see if we can put a camera on as well. Let's see what we can do with that. And let me just get back to your presentation. Camera.
Yeah, looks and sounds great though. Yeah, you're in good shape, man. Thanks. No, don't do that. Please don't do the camera.
Don't
Wait,
do
no.
the camera.
Well, no, it's okay. Yeah. No, you look great. Okay. I didn't know if it would
Sure.
show everyone's cameras though. It's just you. So that's
No,
good.
it'll just show mine.
Yeah, I'm kind of new to Zoom, so thanks. But thanks, Oscar. Great job. Good to have you, man. It's good to see what you look like. So welcome
All right,
aboard.
my friend. Thank you. Thank you. And if it's my moment, I will get started.
All right.
All right, so let me start with this. Good morning, good afternoon, and good evening, traders from across the globe. Welcome, welcome. Thank you for tuning in to Ken's presentation today. And a round of applause to our speakers. I've been listening. It's been fantastic. Thank you so much. Ken, thank you for the opportunity. So if you don't know who I am, my name is Oscar Carboni. You can always find me at livewithoscar.com in a free live trading room. In fact, it looks like this, although there's usually lots of people lined up during the week. I am live on camera and microphone. No credit cards are required. Just show up. It's really simple. You go to Live with Oscar, you click register, you end up here, you click chat, and you end up chatting with me live. So one of the things I have learned since I started in this business in 1982, working down on the trading floors, was that you've got to keep this simple. This is a very complicated business. And if you add complication into a complicated business, well, you're just making it more complicated. So I'm going to show you some charts that are going to keep things very simple for you. But these charts should show us the path of what we can do to make money next week. So let's go take a look. In fact, every night I do a YouTube video, or just about every night. The video looks sort of like this. It starts out.
Good morning, good afternoon, and of course, good evening, traders from across the globe.
And then I usually will show you charts and depict exactly what I think is going to happen. And then traders will come find me in my live trading room afterwards, where we huddle together. And this is why they follow me. On Thursday evening, this is Thursday evening's chart. A question was presented to me, Oscar, is this a bull flag? Should we be getting long right here? So, of course, I did a YouTube video that night, and I said, well, let's take a look at this. My viewpoint on Thursday, before Friday's trade, is that, yes, it looks like a bull flag, but first thing is the flag itself is longer than the pole. Right off the bat, it makes me think, I don't think that's a bull flag, but let's look at more. So I decided I'd add an average in, and the average that I use is one that's programmed into every algorithm on Wall Street. You go with these simple averages that all of them know about, and you will find that you are in the correct zone. You're trading with the smart money. So two of the major averages that you will find programmed into anything on Wall Street is the 50-bar moving average and the 200-bar moving average. So we like to keep those around. So I'm looking at this and I said, well, we are below the 50-bar moving average right here. Its flag looks a little longer than its pole. I'm going to go investigate. Let's go look at a few other markets.
Hey, Oscar,
Yes.
sorry, quick interruption. We can't see the charts. We see all the tickers here, but you may be sharing a
chart.
Yeah, we're seeing all these tickers like ESH23, NQH23.
Oh my goodness.
You might be sharing the wrong screen. Maybe.
Let's find out why. Let's take a look at share. I believe on here is a share button, right?
Yeah, click the share screen and then click on the one that you want to show, and you should be good to go.
Maybe that's the one I've been trying to show you. That's not it either. Hold on a minute, gentlemen. Usually this just works. So I'll figure out what I should be showing you right now.
Yeah, well, I can hear and see your face talking, so that's good.
Not that. It should literally be this, but let's try that one.
It's showing NASDAQ Daily NQH23. Okay, yeah, now it's zoomed in. Yeah, that looks good. NASDAQ Daily NQH23.
You're looking at a chart now.
I am looking at a bar chart now, right? Yeah.
All right, very good. Now, is that, can you see me moving?
Yeah, looks good.
Well, let's go back to where we started this. All right, let's start this over. So,
no, we can keep going, but great presentation so far, man. It's interesting stuff. Yeah.
Listen, so this was the flag. This was the question presented. Oscar, is it a flag? And I looked at this and said, well, the flag itself is longer than the pole. So right off the bat, I don't think so. I dropped the 50-bar moving average in and said, we're below the 50. But let's go investigate. Let's look at some other sisters, if you will, of the NASDAQ. We'll find out what we should be doing on Friday. Is this a bull flag or not? So we'll move to another chart. And we'll look at the Russell 2000. So for the Russell 2000, let me just move some of these controls out of my view here. For the Russell 2000, I looked at that, and this bar didn't exist. This is Friday's bar. And I said, looking at Thursday, I don't think Russell being below the 50 and below this channel, I don't think NASDAQ's a flag. I don't think it's going to hold, but that's not the only chart I would look at. So I said to my Omniacs who are following me, before we do anything, let's look at a few more. So I'm going to show you what I did in my analysis on Thursday, not for Friday. So we'll go look at the transportation average. And that should show us something. Well, we'll start with the Dow, actually, and take a look at this. So we looked at the Dow, and this bar didn't exist either, right? Thursday for Friday. This is Friday's bar. We looked at the Dow and said, well, I don't like the way that looks. I know Wall Street loves the 200 bar moving average. Let's throw that in. And we throw that in. So we're down here. We've got a 50 and a 200 crossing, but we are below this flag looking thing. And even more interesting than that, look at the size of this trend line. It comes all the way back from the highs. You hit it, you drop. 200 bar moving average and the trend line. You hit it and fail. Get back to the 200 bar moving average. We actually get above, get into the flag, but failure comes our way again. And now we're on Thursday evening. We're about to test the support. Used to be resistance. Becomes support when you get above it. Tests it and holds. All right, looks good. And we come down here, but then we add Friday in and we have fallen apart through there. So looking at the charts for Thursday tells me that NASDAQ is absolutely not going to be a flag on Friday, but we're not done looking there. We're going to look at a few others. So we go and look at the S&P, and again, we remove Friday's bar because it doesn't exist yet, and we're looking at Thursday, and it just looks terrible. Look at this weird-looking flag, right? What happened on the day the CPI came out, this green bar went up and went right to the top of that flag, turned around and dumped below the 200 bar moving average, below the support. We're keeping this simple, traders. I promise you, the algorithms that we're trading on Wall Street, they are based so much on the algebra in the markets. The algorithms are based on what's happened in the past and what that should mean going forward. And I promise you, Wall Street has this line programmed in. They don't have it programmed in as a visual line. They've got it programmed in, of course, in their tabular calculations that the market had reached here and it reached here. And when it reaches there, you sell it. And look at what they did. They came right in and smashed it. Wall Street knows, and I try to follow the simplicity behind what they're doing. So look at this flag. We fell through the flag as well. Below the 200, below the 50, there's no shot. That's a bullish flag on NASDAQ, but I'm not done. I also go look at the transportation average. And this is all before I decide whether or not I want to trade that NASDAQ. Well, the transportation average, really, this chart says it all. There's a lot on here, so I'll take it slow. You've got the 200 bar moving average, and we'll take the 50 off for now, just to start with the 200. So you've got the 200 bar moving average. We know every algorithm in the world's got that programmed in. The market rallies up and hits it and fails miserably. This is the Dow Jones Transportation Average. Goes back up. What's it do? It hits the 200 again. Believe me, algorithms are programmed to know this. Comes smashing back down. Gets back above the 200. This time spends a good couple of weeks there. Gets below. One last gasp of air. Back below the 200. And now check this out. Now we're challenging the 50. And I promise you, Wall Street is all over this. They're watching it too. And now we are challenging the 50. So what has happened is we've failed and dropped, illustrated by the red arrow, failed, dropped dramatically, failed, tried one last gasp, failing dramatically. The drop should be dramatic. So we are looking for some downside. Not everything goes straight down, but we're looking for downside. But of course, I am not done investigating yet. I don't trade until I fully investigate everything I'm looking at. So the next thing I would do is start to look at weeklies. So this all started with the NASDAQ. Let's go back and let's flip this to a weekly chart now. Let's go out a little bit. And I'll tell you right now, this one scares me, and you'll see why. This weekly chart, every one of these bars represents 1 week. And this is simple, but watch how powerful. You are looking at the NASDAQ on the weekly, and here's why this scares me. You see what we're doing, challenging the 200 ball moving average right now? And I promise you, it's in all the algorithms on Wall Street, as I keep mentioning. Well, watch this. The COVID low did not take out the 200 ball moving average. Now we're going to go back in history. We did not take out the 200 ball moving average at all. No matter what happened, we never took it out. Where are we now? We're all the way back to 2016. Still never hit it. Let's just keep going. There is nothing that took out, that made the NASDAQ break the 200 ball moving average except for the crash of 2008-9. Nothing else has brought the market down, the NASDAQ, low enough to hit this average. Now, here's what worries me about that. Let's go take a look at some other charts. Now, you see we're clearly below the average right now, and that does not happen. So if NASDAQ's below the average, what else is? Well, let's look at all of them. We go to the transportation average. First of all, I cannot tell you how ugly this epic failure looks at the top of this channel, right? Failure, failure. Look at all the times it tried to get above and is now below. That is an ugly close that we've seen on Friday. And I kid you not, this projects down to 10,800, 10,750. And that is a simple projection. Why is it simple? I'm just simply looking at this. Look, bottom, top, bottom, top, bottom, top, bottom. Wasted a lot of time at the top. It is now going to head to the bottom. Simple. That is what will happen. I kid you not. There isn't a single algorithm on Wall Street that doesn't have this programmed in right now, recognizing where it keeps failing at. And as you can see, they work hard up there, and it will now start to come down. Once you get below the 200, it gets uglier. Now, we know nothing comes straight down. Things move up and then back down, but this is on its way down. Now, here's what makes NASDAQ weekly bar scary compared to the others. Dow Jones Transportation Average has touched or broken the 200 ball moving average 7 times since 2008. What do I mean by that? Here you've touched, let's go back, broken, right? During COVID, the COVID low, you could understand it breaking, but NASDAQ didn't break there. Now let's move back. We break it again, 2018. Let's keep going. We break it again, 2016, twice. These are weekly bars. It's a lot of time spent under the 200. We break it again, 2011. We break it again in 2010. And then, of course, the crash of 2008, 09, you'd expect that. 7 times the transportation average hit it. So that's more of an average thing that happens in the transportation average, hitting the 200 bar, but not the NASDAQ, right? So the transportation hits it a bunch of times. Let's go look at the Dow. Check this out. The Dow Jones, 6 times it hits the 200 ball moving average all the way back to 2008. You've got this one. You've got COVID where you smashed through, as you'd expect. And we go back. You could go all the way back, and what you'll find is that if you go all the way to the beginning of this chart, you still have not hit. So very interesting that the markets are crashing into the 200 ball moving average very often, but not the NASDAQ. That's what's got me a little bit worried here. But we're going to look at a few more because that's not enough picture. So we're looking at the Dow on a weekly. Look at what the S&P did on a weekly. If you look at the S&P, let's stay up close first, right? Let's pull up, zoom in close on this chart. This is a weekly S&P bar chart. Look at the epic failure at the resistance every time we get there. Every time. Simple trend line, right? How could something this simple work? Because it's programmed into algorithms. And look what happens here. Epic failure. And now we're heading back to the 200 ball moving average. Now, how often has the S&P broken that average since 2008? Let's go back and look. So if we want to see, we're looking right now, S&P breaks it here and then moves back up. So that's touch number 1. During COVID, you break it again. And let's move back. You touch it in 2019, break it. 2016, we touch. 2011, we break it. 2008, 9, of course, 2008 through 11, it was below the 200 ball moving average. Not the NASDAQ. Interesting. How come the NASDAQ doesn't do that? So let's go back here. Now,
Yeah, sorry, Oscar, your charts are frozen. Everyone's telling me to. We're stuck on the Dow Jones Industrial Weekly. The
this
traders
one
are
right
asking,
here.
Yeah. They're asking me about the other charts that you're talking about. So I don't know if that's the one you were trying to show or not.
So are you seeing this chart moving right now?
I'm not seeing anything moving. I'm seeing Dow Jones Industrials, DJI Weekly. Great presentation so far, by the way, man. I like it. You know what you're talking about, man. But
God,
yeah,
I wish I could show this to you. This is going to culminate somewhere if I can just get it finished.
Well, I see you. I see your cursor moving now. So are you? Do you mean to be on the Dow Jones Industrial Week? Yeah.
Weekly chart.
Yeah. So
This
the
is what
traders
you're
are.
watching right now.
Yeah, that's what I'm watching. But the traders are saying you're talking about other charts. I don't know what they're talking about, but like 8 people say.
So I did just have, I see. If I get off charts, you guys didn't see this, huh? I'm on a different chart right now. Okay, so I have to stick with this one chart only. I understand what's going on. Your screen is showing this one particular chart only.
Yeah, right.
It doesn't show the other charts. Okay.
I'll whatever's on the one screen. Yeah.
Got it. I'll stick to this one chart.
Okay, man.
So I can show you the same thing on the S&P using this chart. Let's go to the S&P. Thank you for letting me know about that. So if we go to the S&P, this is the E-mini S&P. I'll label it. This is a weekly. And if we go back, and in fact, let's make sure that we load a lot of bars here. So let's go load 30 years of bars. And you'll see that the same thing happens. You break the 200 bar moving average quite often, right? We've got it broken here. We've got it broken here. Here, you broke it again, 2018. E-mini S&P. Here, you missed, right? But you came close. Here, we broke it again, 2011. And finally, 2008-9. So the E-mini S&P also breaks the 200 often, but NASDAQ does not. All right, do charts break them? Let's go take a look at everything else. Let's see what Google's doing right now. Google on the weekly, 5 times either broken, and we're at it right now, or touched since 2008. So Google will do that as well. And let's go take a look at another stock, Tesla. If there's questions after I'm done presenting, I'd be more than happy to answer them. Tesla, because it hasn't been around long enough, the 200 bar, we can't go back 30 years, but we are below it right now. I promise you, these major stocks that are part of the S&P, NASDAQ, they are below the 200. NASDAQ's going below the 200. That's the way it works. There's no way to stop that because the NASDAQ's made up of these stocks. And if they're going, NASDAQ's going with it. So let's go take a look at Amazon. So check this out. Amazon, one time only. Only one time has it ever broken. And Amazon is a huge part of the NASDAQ, right? One time broken only since 2008. Never breaks it, never, ever. 2008, that's it, just like the NASDAQ. Well, if one of the biggest components of the NASDAQ has gone through and is on its way down, I have to say that NASDAQ's going with it. Let's go back to NASDAQ now. This is a weekly, right? If we go back to NASDAQ, you must realize there's something happening here that never happens. It just doesn't take place. You do not break the 200 bar moving average with the NASDAQ. So I think this is telling us, kids, we've got some downside coming. Nothing goes straight down, but there is no way to stop that from happening, as you can see right before our eyes. Now, if we go back to the daily in that NASDAQ, let's go daily. You can see that, in fact, that was not a flag. We have broken it. We are below the 50. And Wall Street's going to start to hammer this. Now, again, might not go straight down, but I think we're set to reach a larger, lower level. I had given you a projection on the Dow chart, or excuse me, on the transportation chart. I think we can easily get to that projection as we work our way lower after this year ends. And let's see, we can take a look at one last chart if you would like. And let's see, this is the DJIY. And what's interesting about this guy is what I showed you a little bit earlier. We are about to go take out this mess down here. And when the averages cross, as you've seen other presenters mention to you earlier, it's a biggie on Wall Street. When they start to cross and you get below them, it sets off alarms all over Wall Street and algorithms. That's what's starting to happen. Now, I've shown you a lot of reasons to think the market could go lower, but there is something else that's been happening for quite some time. Many of you have heard me mention this, that could actually help the market instead of following it lower, and that is crude oil. Watch this. In crude, I have been extremely vocal about the price of crude all year long and last year too. If you can get crude under 77, it buoys up the stock market. It's just a magic number. Now that 77 number floats around. Right now, it happens to be 77. So I've mentioned this to many of my traders, and of course, I'll show it to you and I'll prove it to you. So what I tell them is, if crude gets below 77, it buoys up the stock market. How can I prove that? Well, check this out. Crude oil, 9 days ago, count them, 1, 2, 3, 4, 5, 6, 7, 8, 9 days ago, finally gets below 77, 9 days ago. Let's see if I can show you the same thing here. Watch this. Exactly 9 days ago, we put our bottom in the Dow. Right there, exactly 9 days ago. Let's go back. Let me show you that again. 9 days ago, crude gets below 77. 9 days ago, right? Just go back 9 days, right there. And I profess that will help the stock market go higher. Let's see. 9 days ago, we put our bottom in, exactly 9 days ago. I am telling you that 77 level has a lot of meaning to our market. So if we go back to crude, and you'll see that technical analysis is absolutely the roadmap to what's going on. How do we know that? Well, what would make something like this trend line mean anything at all? Why would this stop the market and the average? Boom, trend line. Just about trend line and average. Comes back down. Boom, stops at the trend line. Comes back down. Just about hits the trend line, starts to head back down. Why on earth would that work? Why would this silly line mean anything? It doesn't mean anything unless Wall Street's using the same things we are. It's a self-fulfilling prophecy. So if you draw your trend lines correctly, you use simple averages, you will be in line with what Wall Street is doing. Then, of course, we have to come up with exactly where to buy and sell each day. That I use my Omni trading system for, Oscar's market navigational indicator, which we will not be seeing in today's presentation, but I wanted to show you the simplicity behind these charts. Now, if you can get crude to get to the bottom of this channel, you will get the stock market to head straight back up again. That has been a seesaw. And just go back and count 9 days for yourselves on your charts, traders. You can see it for yourselves. So I wanted to show you that. We are set for the downside. Just keep your eye on crude, because if they can hammer crude enough, it will buoy back the stock markets again. Ken, if there are any questions, I'd be more than happy to answer them.
Hey, well, Oscar, I just wanted to say thanks for an outstanding presentation, man. You're always welcome to come back in my book. You know your stuff, and I picked up some tips too from you. I appreciate the focus on, like, you got a smart way of thinking about it. Like, you look to see where's an outlier, so NAS hasn't lost to 200 until recently, and that's important. That's an outlier data point that, like you say, Wall Street pays attention to it, and that makes sense. So that's the kind of signal. You see, as traders, we're all out there in the fog, and we're trying to look all the noise out there. Where's strong signals? And you got a really good handle on it. So
it's simple. Now, I will tell you this. This is my technical analysis 101 that I could do laying on the cot, having milk and cookies in kindergarten. This is like the simplest I can get. I can show you much more complicated analysis, but why complicate things when we can show it in simplicity?
Right. And you did an outstanding job, man. Hey, let me ask you a parting question here, because we got a couple of minutes. You and I talked on the phone. I was really impressed with what you're talking about ladders, and that's going to be something I'm going to talk about. When it comes to position sizing, the mechanics of trades, I like to split my trades into pieces and scale in. So I'm throwing a lot of darts at the market and really super tight stops if they crap out. And if they work, then I start martingale or scaling into them. How do you look at things in terms of position sizing or ladders or a sequence of trades?
So position sizing, of course, never trade without stops. Put your stops in first. This is a very risky game. You can lose so much money in this game, more than you've ever dreamed of having. So never trade these markets without stops. Everybody listening knows that, right? The other thing I tell people is if you want to keep your margin risk reward ratio in check and never be part of that margin game clearing firms put out there for us, you trade one lot for every $10,000 in your account. You will never have a margin call. One lot of futures. You will never have a margin call. You will never lose too much on any one trade. So every 10,000 in your account, you're a one lot trader.
That's good to know.
You're a two lot trader. It's the way to trade around basically they give you too much leverage in futures. They allow you to hang yourself. You put $2,000 in your account, you can trade an S&P. That's a little thick. They'll let you. So the way to stay out of their game is one lot for every $10,000 in your account.
Now, see, that's actionable intel. That's good stuff. I appreciate it, Oscar. It's simple and it's solid and it's correct. You're honest and it can really help traders. So that's, you and I both we're in the business trying to help traders make smart decisions and be more green than red. And you've shared a lot of great tips. So really appreciate it, man. You're welcome. You're always welcome to come back and present the future events too, man. You know your stuff. So thanks.
And I am here anytime you guys need to reach me. Just come to Live with Oscar. I sit just like this in my live training room and we live together. See, it says Live with Oscar. It's more like Live with Oscar. I'm a trader 24 hours a day. If you are, just live with me. It's what we do.
Yeah, it's a great job. Hey, well, thanks so much, Oscar. Appreciate it, man. It's a privilege having you here, man. And I'm glad I invited you because I picked up a couple of new tips myself, and I appreciate your being straight with everybody. You know your stuff, so thanks.
Well, thank you, sir. I appreciate it. Thank you for tuning in, everybody. I hope this helps you next week to make a few dollars.
All right. Well, let me reclaim the host, and thanks, Oscar. And we're going to turn it over to Marina. She's our next to last presenter coming right up, and then I will speak at 2:30. So let me see. Oscar, maybe could you turn off the video and?
Absolutely. So long, ladies and gentlemen. Thanks for tuning in.
Hey, thanks. Appreciate it. All right. And last but not least, next to last, we've got Marina and then myself. And a privilege to have so many of you here. A really big turnout today. So thanks to everyone for being here. I'm trying to change this over. All right, Marina, are you there?
Hi. Yes, Ken, I'm here. Hi, everybody. Can you hear me okay?
Yeah, we can hear you, and I turned over the control to you, so you should be able to show your screen, and we'll be underway.
Okay, wonderful.
So we've got Marina Villatoro here, the Trader Chick, and great to have you here. It's always good to have a variety of people, and looking forward to seeing your presentation. So let's see.
Thank you, and thanks for having me, Ken.
You
Hi,
are
everybody.
welcome. Looks great. Yeah, looks and sounds great. You're in good shape.
Awesome. Hi, everybody. Thanks so much for being here today. I know that it's a Saturday. Saturdays could be a little bit tricky, especially, it's when we get all our stuff done and right before the holidays, which I can't even believe it's almost the holidays. Hi, everybody. So I would love to know, where are you all coming to us from? Where am I chatting with you? Because I know that there's a lot of people in the room. So where are you guys coming from? Maryland, Chicago, Canada, New Jersey. Nice. Where in New Jersey? My parents live in New Jersey. Denver. I lived in Summit County, which was like an hour and a half from Denver, I think. And Henry is from the Netherlands, and San Jose, California. Nice. Steve is from Philadelphia. My brother studied at University of Pennsylvania. We used to go to Philly a lot. Oh, San Diego, Gene. I lived there. I lived in Pacific Beach for a long time. I loved San Diego, loved it. Gulf, Canada, Bill. It's an interesting name. I don't think I've ever heard that. And staying in Las Cruces, New Mexico. Princeton. I love Princeton. Love Princeton. We went a couple years ago. There was this one, oh my goodness, I forgot. This one garden where they brought like these paintings to life. I'm sure, Daphne, you probably have seen it. I can't remember what it's called right now. It's only open during, I think, from March through October every year. It's amazing. Albert, you are in Italy, and Deborah from California. We have from Oregon, Sandy Hook, That's Connecticut. North Carolina, used to live in New Jersey. New Brunswick, nice. Bernard is from Copenhagen. And Kevin Cooper and Breck, yes, so I lived in Breckenridge area, Summit County. I don't think Copper Mountain was in Summit County. I can't remember, but we used to ski Copper a lot. So I'm so happy we have like pretty much the whole world here. This is such a great time. Well, today I want to do a really quick but very powerful presentation, 4 steps to simplifying your day trading and how to dominate the market condition. My goal is for you, I always actually teach this to my kids. I'm like, if you could get one really powerful thing that really resonates with you and that you could implement it literally like right away, that is my goal, because that one thing can literally take you to that next level. So that's my goal. It's going to be a simple yet powerful understanding. So again, if you have any questions, I would love to know this. This is me. I am Marina, the Trader Chick. So interesting. I am an expat. I have been living in Antigua, Guatemala for almost 14 years. I've been an expat for almost 20 years. We lived in Costa Rica before. So as of 2 days ago, we are technically nomads. I'm still in Guatemala, but we are actually waiting to move to Spain, but our visas have not come through yet. So even though I am an expat in Guatemala, I don't technically live in Antigua anymore as of 2 days ago. It's a bittersweet idea, but regardless, me and my family right now just started our travels while we are waiting for our visas. And tomorrow we head to Mexico for the next 3 weeks. So I'm actually really excited. I'm actually excited for this new transition. Before I became a day trader, I was a fitness instructor and a travel writer, but I'm still actually a travel writer. I still run my travel site, which talks all about our travels and whatnot. And the main reason I bring up that I was a fitness instructor, mainly because a lot of people believe that they need to either have a financial background or an engineering background, but you don't. The coolest thing about trading is that anyone and everyone can do it. That's the beauty of day trading, right? So I'm also trilingual. And the main reason I am saying this is not for you to be like, oh, how cool that is. It's because, first of all, I am a Soviet Union refugee. So my first language was Russian. But my main language is English because we arrived to the United States when I was really young. So instead of actually learning English, I kind of just continued learning how to speak and picked up English in that time frame. So I didn't really learn it. It just, kind of happened. That's the beauty of kids, having accessibility to many languages when they're young. But Spanish, I learned in my late 20s. And that is a full process, right? Like you have to commit, you have to be disciplined, you have to practice. There's all these things that go with it, right? And it's a process. And when I started trading, it's now almost 11 years ago, I struggled for quite some time. And mainly the main reason I realized was when the click happened for me is that I started to look at it as its own language, that the market speaks to us. And I think I was able to do that because I learned another language in my later years. And when I talk about this to people, a lot of them are like, you're right. If I just look at it like that, all of a sudden you could start to learn to listen to it and to read it rather than try to beat it or predict it and kind of stuff like that. And all of a sudden you could start to become really successful at it. The coolest thing for day trading, guys, is you could literally do it anywhere. Now that we are literally nomadic, I have one computer. I work everything from one chart. So I am not going to stop working. I'm not going to stop trading just because we are now nomadic and have no idea when we'll actually end up in Spain. So in the meantime, not much really changes. And that's really important for me. That was super important for me so that I could continue the lifestyle like that all the time. And before COVID, I used to actually do a lot of live in-person summits like I am today. But I actually, after COVID, I kind of prefer the virtual because I could speak to so many more people and it's just a really more fun experience. So what I want to talk about today is the basics of day trading and how we can actually have fun in the day trading, similar to like when we go on road trips, right? Like we have fun when we go on road trips, but when you're driving a car, there's an actual, risk of an accident or a fatality. But when we're trading, we kind of lose that fun because we're so fixated on the loss of the money, right? And it takes away from that joy of it. Yet it's just money, guys. It's just money. You could always find a way to make money. But when you're driving, you're having that fun. And the reason why we can have so much more fun while we're driving, and I use this analogy, is because we have the automatics, the basics down, right? We know where the steering wheel is. We know where the clutch is. We know where the brake is, where the accelerator, where the gear shifts are. A lot of times when the thing is with trading the financial markets, there's no barrier of entry. Anyone could do it if they have a teeny bit of money, and they overlook these basics and then just start putting their money into the market without even knowing, is it going up, is it going down, are you going for a short, a long, or not even understanding the difference between what is a short, what's a sell, what's a long, what's a buy, right? So what I want to talk about is those basics, right? So that when you come into the market, you have that foundation. It's like literally like saying, oh, I want to trade and just throw my money in the next day without, having any idea about it. It's kind of like me saying, well, I want to learn Spanish, and then literally the next day enter a conversation with 6 fluent native Spanish speakers and expecting to keep up with them. It's not possible. You have to first learn, hola, mi nombre es Marina, mucho gusto, like the little basic things to even enter a conversation. Right? So that's what I really want to talk to you guys about today. Now, the cool thing is I actually have the entire presentation in a worksheet for you, because I know we only have, 30 minutes together, and the worksheet is done really easy. So you could follow along, and you could actually even write to me and I can help you again, but you could go here. It's totally free. makingofadaytrader.com. You could go in right here, makingofadaytrader.com, and you could get it right here, makingofadaytrader.com. You can go and grab the presentation, and you'll be able to follow along with me right now as well. It kind of works with this presentation, and again, it's done like a cheat sheet. So makingofadaytrader.com, go in there, guys, put in the URL and get it. All right, let's get into the nitty-gritty. What is the market movement and the breakdown of a trend? I mean, we all understand the basics, right? Like we logistically know that there's an upward trend, a downward trend, but the reality is the sideways trend, that is where we end up losing the majority of our profits or even the money in our banks. Why? Because this is the exhaustion pattern, the indecision area, the chop, the consolidation, whatever you want to call it. It's an area where we don't want to be putting our money into because it's not really confirmed which direction the market is going to go to. And today I'm going to show you how we could spot these areas so that we don't continue losing our money in those areas. But first, just a really quick understanding. What is an upward trend? It is literally where each pivot is higher than the next, and this is where we enter a buy. This is when we go long. Literally, we just put in our money at a lower price point, exit at a higher price point. But you need to know, you have to have a strategy for it. You can't just be putting your money in, right? What is a downward trend? It's literally the opposite. It is when each pivot is lower than the other. Okay, and what do we do here? We're selling. We're looking for the shorts. What does that mean? It literally just means you're entering at a higher price point, exiting at a lower price point, and you're taking that money in between. And a good professional trader probably makes more money on the downward, on shorting, than they do on going long. So keep your mind open to be able to do both, because it all boils down to technical analysis, 100%. All right, guys. So let's dig in to the consolidation area, the sideways trend, this area, I call it, and it is, I totally believe, the trader's worst enemy. And once we learn how to spot them and avoid these areas, we can save so much more money and make a lot more money. Now, what are these areas? These are the channels, the chops, the indecisions, it's the stale movement, more or less, right? It's the consolidating market, right? It's where there's really no actual movement. Like there's so much indecision here, uncertainty, that it's not it's not worth putting our hard-earned money into it, right? Into the market. It's really important to be able to put our money into a higher probability area where we know that there will be a higher probability chance of winning rather than trying to beat the market and trying to figure out where it's going. Why do we end up losing so much money in these areas? Have you guys ever actually thought of it? The thing is, trading is a very emotional experience, right? And it could really mess with your head. And what happens when you're emotional is that we're starting to tell ourselves deceiving stories, right? Like a good idea of what a story is, for instance, you meet somebody who you made, it's like a new friend. You have a new friend, and they say to you, hey, I'm having a party in a couple of days. I would love for you to come. Do you want to come? And you're like, oh yeah, that's so exciting. Okay, I'll call you tomorrow and give you the directions. The next day comes along and they never call you. So what do you start to do? You get emotional, you start to create stories. Oh my God, did I say something wrong? Maybe they met somebody and they said that they're going to invite me and that person didn't like me. Maybe this and maybe that. And for some reason, our stories are always negative. I don't know why that is, right? We have to change that narrative, but regardless, they're usually negative. So you're all upset. You're totally in this emotional state of mind. All of a sudden, this new friend calls you 2 days later. They're like, oh my gosh, I'm so sorry. I dropped my phone in the toilet. I lost all my contacts. It took me this long. So basically, there was no story. It's a total lie. When we're looking at a market that looks like this, we're telling ourselves those lies. Why? Here's the reason. There are two types of traders. The trend is your friend trader. And when they look at this market, they're saying to themselves, you know what? The market's been going up all day. I'm going for a long. Then we have the contrarian trader, and they're looking at the market and they're like, you know what? The market's been going up all day. I'm going to short it. It's got to correct. Both of those are total stories that aren't real, because the only thing that's really real is what the market is telling you. And that's, hey, I'm in a decision right now. It's a good idea for you to just sit out. Wait until I tell you what to do. And that's the most important thing. And these areas happen a lot. And sitting out and knowing that we need to sit out is the most important job of the trader. We need to understand when, and we have to mark these areas, because that's when we can see when the transition and a new trend happens, or a breakout trade. Right? Those are the top trades that you could possibly be in. But if you don't understand these areas, or you're too busy trying to predict or beat the market because you think you know better, by the time the good trade comes up, you're either completely broke or super emotional and then just revenge trading, right? So how do we even recognize these areas? The thing is, the market respects areas. We as the individual traders also have to respect these areas. What are these areas? They are support and resistance. Support and resistance areas, guys, these are so important. And you can't just do a mental support and resistance area. You need to draw them in. I call these the safety gears of the market. And I'll explain to you in just a little bit. What is a support area? It's literally the floor of the market. It's when you have a downward trend, all of a sudden, boom, you are constantly hitting a floor, and the market respects that floor over and over and over again. And you want to stay out of that area because it can completely stop you out. Even if it could look strong, it could just hit that support area like a brick wall and bounce off of it and continue in the opposite direction. You don't want to be in the wrong side of the trend. Okay, why do I call these the harnesses? Because look, the resistance area, it is the ceiling of the market. This is where the market, when it's going up, it's hitting over and over and over again. And when you draw this area out, and if the market is coming close to it, you already know, you know what? I'm staying out, because I know that this could be, a place where I could be bounced off of. Here's the thing, guys. Formula One drivers, we all know about Formula One racing, right? I don't care if you watch it, if you don't watch it, but you know what it's about. It is a known fact in the Formula One racing world that 25% of the drivers during racing season will either have an accident or, even worse, a fatality. So would they ever just jump in their car that goes 220 kilometers an hour? No. They're not stupid. They put on their helmet. They put on their fireproof uniforms. They get in the car and they put on several seatbelts. 95% of people who want to trade fail, lose money. Why? Because they don't put any seatbelts on. They just put their money into the market. I literally call it donating the money to the market. When you have your resistance and support areas drawn in, you're already protecting yourselves, knowing that the market will hit that area and most likely bounce off of it or not go very far. So why do you want to be putting your money into an area that is very distinguished by the market and respected? Okay, now the real question is, how do we spot those areas before they actually become areas? Because it's one thing, you know, in the beginning, you get it, you get stopped out, okay, but you don't want to continue. And how do you start to recognize these areas? For me, I call these areas, the trader's map to shift in direction and trend. This is the reversal areas and divergences. What are reversal patterns? Double bottoms, triple tops, double tops, head and shoulders. These are, they're free. They could be found on any platform, any instrument, and they are so powerful. Guys, you need to read the market, and I guarantee you, if you could read even just the reversal patterns alone, it will save you so much money. It will keep you out of bad markets. So what is a reversal pattern? It is not 100% saying that it's going to reverse. What it is telling you 100% is that the market is slowing down. It is losing its strength. You never want to be in a market that's becoming weak, right? And then what is a divergence? I personally use the MACDs as one of my indicators. I only use 2 indicators, but I find that the MACDs are the least lagging indicator out there. And as you can see here, we have a perfect double bottom. You can see here, the line is straight on the price action, but the MACDs, it's incline going upwards. That's divergence. It's literally when it's divergent, 2 areas that are not being identical. And that's really important, right? So you can see that here as well. Actually, I use it way more than just with reversal patterns. I am a very conservative trader. So as you can see here, the price action is going down, but the MACDs is already starting to flatten out. So it's already showing me and indicating that the market is starting to lose its strength. So I don't want to be part of a market that's losing its strength. All right, guys. Now, when you have these ideas, when you understand what those areas, you can start to really understand the higher probability trades. And one of the most highest probability trade out there is the breakout area. So how do we spot those valid breakouts? Well, for one thing, we've already spotted those reversal patterns. We have drawn in the resistance areas or drawn in the support areas. So when the market actually comes out, boom, we can recognize it, okay? So let's put all of this together. Like I said, first and foremost, you need to have a chart, right? You cannot be doing this on Robinhood. You cannot be doing these mental support resistance areas and all these, you know, even the mental stops, like they're completely ludicrous. What is a mental stop? It's literally like saying, I'm going to get in the car, put on a mental seatbelt on my baby, and if I get into an accident, I'm going to save it. I mean, come on, it's totally ludicrous. So like I said earlier, my entire presentation, I have this for you because I know we have a very short period of time so that you can really review it, and then you could write to me and I'm happy to go into it a little bit further. Go here, it's totally free, makingofadaytrader.com. Go here right now, makingofadaytrader.com. You can just literally put that into the URL, makingofadaytrader.com, and boom, it will give you the presentation for free. Now, let's talk about the breakout trade setup because it is probably the most it's probably the most highest probability trade out there. Why? I want to explain this to you. Okay, so here we had an upward trend. We're going up and we drew in this resistance area because it's just popping back and forth. But all of a sudden, it breaks out. It continues. Look, here's the way I looked at it. This is a super strong resistance area. Right here, this dotted line on the MACDs is where it's 0. I put in these brown lines as my own milestones. And when it hits these areas and goes above it, I know that there's massive strength. But when it kind of bounces around in here, it's showing me that it's super slow. But all of a sudden, boom, it broke out of the resistance area, broke out of my MACDs. This is where I want to be entering. And I don't just enter aimlessly, right? Market orders are only for amateurs, because not only is a market order telling the market that you really have no idea what you're looking for, it's also telling the market that they could take more money from you. And that's called slippage. So if you're entering a market order, usually the market takes around 20% of what you originally wanted to get out of it. However, if you put in a limit order, if you actually tell the market where you want to go, the market, number one, realizes, wait, this person does know what they want. And it's also giving you the exact price you want to enter at. And that's how I use my EMA lines. That's my other indicator that I absolutely love. It's like archery, right? Again, I don't care if you guys never tried archery. We've all seen archers, you know, whatever form, and they never just walk around aimlessly on a field. They always stand at a specific line where they shoot their arrow into the bullseye, right? This is how I use my EMA lines. This is where I take my mark from to enter the market. And I have another bonus setup for you guys. I call it the initial instant reaction trade setup. And what it is again, you have to mark off your charts. You have to see what's really happening to be able to understand when the transition happens, you're already ready for it. What is a transition? It's literally a new trend forming. What is a new trend forming? I'm going to give you an example. Okay, so imagine you want to, just imagine this. You want to go for a jog. You hop into your jogging clothes, put on your sneakers, and you're out of the door. If I was to put money on you going the furthest, that would probably be the strongest part of your exit, right? Is because that's when you are leaving the house, you have the most amount of energy. New trends in markets, that's how they work. That's when they have the most amount of strength. So when we and I call it that initial instant reaction, right? Because here we are finally breaking through this area, and now we're transitioning into that new trend. This is what gives us the most amount of profit, because that's when we have the most amount of energy. The trend has the most amount of energy to continue a little bit further, that you have a higher probability of earning more money with the trade that you enter. So again, this is my other trade that I really love, and I take in that manner as well. So basically, guys, like I said, the entire presentation you could get here, makingofadaytrader.com. You could go and get it there. This was a really quick presentation. I understand we don't have that much time, but I hope that you guys got like some really important ideas from it to really be able to apply it. Even if you just apply reversal patterns, right? When you're spotting those double tops, triple tops, double bottoms, triple bottoms, or head and shoulders. Again, it's not about that, oh, this is 100% reversal. No, it's about, all right, this is a 100% chance that the market is slowing down and can actually go into a consolidation or a channel where the majority of our money gets lost, okay? That could be one thing that you're really understanding. The other thing is that breakout, right? The breakout trade, like the best way for me to explain it is, imagine that you live down here, right? And your best friend lives up here, and they call you up and they're like, hey, I'm having an impromptu last minute party. Want to come over? And you're like, yeah, for sure. I'd love to come over. So you hop in your car and you hop on the highway that you've been on a million times. You're full of confidence. That's that new trend. But all of a sudden, there's this a massive construction site, and the construction, and they're telling you to detour up the road. And I don't know about you guys, but I get super stressed when I see that, right? Because I'm thinking to myself, oh my goodness, what if they don't continue with the detour signs? I have no idea where I'm at. Google Maps, Waze hasn't caught up to that just yet. What if they, what if they never fix the road? So basically, I'm constantly like the what if, the doubt. It's not a place where I want to put any money into, right? But all of a sudden, the construction worker opens the road and they're like, okay, the road is fixed. You can get back on that highway, going in the same direction. Boom, you're on that highway again, full of confidence. That's the breakout trade. But you can't find that breakout trade unless you have your resistance or support area in, which shows you that indecision zone, that chop, that uncertainty. Okay, guys? So like I said, everything I have is right here, makingofadaytrader.com. You could get that cheat sheet right here. And I hope that you guys enjoyed the presentation. And thank you again so much for being here. And enjoy the end of the year. Happy holidays, everybody. And thanks, Ken, so much for inviting me and having me part of this awesome summit today.
Well, thanks so much, Marina. An outstanding presentation. I was really thrilled to see you had two extremely valid and correct points about, I don't know about you. Well, like you said, I lose the most when I trade inside consolidation zones, and it's still a challenge because I do up to 110 trades a day, and it's really tough. I love trading, but I've got to put the brakes on around 10:30 when things go into consolidation. That was a brilliant point you made. And also I like the point about the divergence, and that's really important. It's kind of like an early warning indicator. So you know your stuff. So it's great. It's the first time we've ever worked together. So I was impressed. I like what you have to say. I think you can really help the traders. So thank you so much for being here, Marina. Good points.
Thank you so much for having me, and happy holidays.
Yeah, happy holidays. Well, traders, how are we doing? Hopefully you guys are doing well. I'm going to wrap up with our final presentation here of the day. And I'm really thankful to all of you for taking time out of your busy holiday season to show up. And we're going to get underway. I'm going to go over some real money trades I did. Let's see. Marina, can you do me a favor and stop your screen sharing?
Sure. Hang
Thanks.
on. How do I do that? It's just, oh, I see it. Boom. Okay. Bye,
All right,
Ken.
thanks.
Thanks,
Thanks.
everybody.
Appreciate it. Thank you so much. All right. Well, thanks everybody for being here. Hopefully I can regain the screen here and we'll get underway with our final presentation coming right up. I'm having a tough time regaining presentation control. Let's see if I can get this right. Sorry, I'm trying to get my presenter control here. Let's see, Marina, do you mind logging out right quick? That might release it because it's still locked up. I can't regain control.
Sure. Okay. Bye,
Thanks.
everybody.
Thanks,
Absolutely.
Marina. And hopefully I'll regain control here. All right. Well, hopefully I've got control. Let's see if everybody can see the charts and we'll get underway here right now. I want to go over some real money trades, so eager to work with you guys here. Let's see, I'm trying to get this to show up. Just a minute. All right, can you guys see my charts now? Just want to do a quick check. Can everyone see and hear everything okay? I hope it's coming through and you guys can see the charts, and wanted to start off. One of the things I wanted to start off by sharing with you is some example of real money trades, because I think there's a knowledge of how to do. What I wanted to start off with is looking at a sequence, and I had mentioned this to Oscar. I did really good yesterday trading this one, UVXY. I went in over 2,000 shares for an overnight hold, so we'll see if it pays off come Monday. But if we take a look, let me show you some P&L proof here because I think that's important. I traded well over 20,000 shares of this yesterday, and you can see I started buying at 746. Okay, and I bought this in 500 share increments. Okay, and so one of the things I wanted to share with you is my strategy for sequential trading, or trading a group or a series or a sequence of trades. Let me go ahead and get my video on so you guys can see me, and we'll get underway. So thanks for your patience. Now, how many of you, a quick show of hands, or just to ask you, how many of you do trade sequences or a series of trades? Because I think it's It's a very helpful strategy. I don't know about you, but when I trade, I like to, instead of, back in the old days, I used to trade, I might do 1,000, 2,000 shares, trade off even lots at a time. And the stop loss cost is too big when you trade too large and too infrequently. So what I found a much more profitable strategy I've been using, especially like yesterday with this one, is I may do, it's more work. That's the challenge, but I will trade a sequence of trades. I may do a series of, 10 or 15 trades or half a dozen minimum. By the way, one thing that I wanted to occur, one of the things for swing or day trading is you want to do a sequence. Now, before we continue on, I do both swing and day trades. Let me ask how many of you, if you would please type in, so I'm going to do my presentation, adjust my presentation on the fly. How many of you are day traders? How many of you are swing traders? Or how many of you, like me, do both? If you would type in just the letter S, D, or both, or type in swing day or both, and I'll cover the types of charts that you guys mostly cover. A really big turnout, so a lot of swing, a lot of both. We'll cover both for sure. But one of the things I want you to learn from me, and again, I like to show P&L proof, swing and both. Looks like, wait, so net, there's a lot of swing traders and not just day traders. So we'll look at swing trading charts right quick here as well. But one of the things I want you to start getting at as an active trader is, like my colleague Tom Sosnov, who's absolutely brilliant, says trade small, trade often. And that's completely correct. Tom Sosnov has often been a speaker here. He'll be with us, I think, in February. A quick note, my goal is to do these every single month at the last Saturday of each month. So stay tuned for additional World's Top Traders events. Well, I'm working really hard to find really good people like we had today. Every person today I learned something from. They're really smart people. Oscar, Marina, Bennett, Steve, and Larry. And hopefully you can pick up some ideas from me as well. So we're going to take a look at some swing trading charts in just a sec. But P&L proof, I wanted to share with you. I was trading thousands of shares of this starting. I nailed the bottom at 746, okay? Now I bought here and I got stopped out at 777. So I bought here and that was a false breakout, and I also got stopped out here, but I made it back, and then some. I made a really green day yesterday because I was in over 3,000 shares running this thing up into the high, and then I sold. Who can tell me what's the bearish reversal sign? I was thinking about sharing this with you guys earlier this morning, but I didn't want to interrupt the presentation. But thanks to Steve Nissen, I knew to sell right there. And I was selling around, I think it was 787, 786, because there's a shooting star. When you wish upon a star, you sell it, punk, right as it loses support, right? So I was nailing it on the way up, and I got out right on the pivot, right under the low of. That's one thing I learned from Steve too, is that you don't just sell when you see a shooting star. You have to wait for it to get right underneath the bottom just a little bit. And the neat thing, like Steve teaches too, is I was kind of confirming slightly above a prior resistance area. So I was kind of skeptical about it, in other words, and I was just waiting to pull the trigger on the sell because it had broken above a previous resistance, okay? And as soon as it printed the shooting star, I started scaling out, and that was correct. Then went in a sideways chop most of the rest of the day. So I played the pivot correctly. We had a congestion zone down here. All right, so those are the kind of charts I like to day trade, is things that have lots of volatility. Now let's take a look at some swing trading charts. Normally I do it, by the way, if you guys want to get involved with learning from me, I've had over 7,000 people have registered for my Trading Week Ahead free Saturday webinars. And they're, I guess, every Saturday except the last Saturday of the month, which will be these shindigs, the World's Top Traders. So if you want to get access to my free Saturday Trading Week Aheads, and I also play saxophone a little bit, you can get the link on the front of my site at trademastery.com. So do register for the free Saturday ideas. Get to know me. I show up every Saturday, and we go over charts of Trader's Choice, and we also take a look at things that are going on. So let's take a look at some swing trading charts coming right up. We'll switch over to our daily. I use a 90-day daily candlestick chart for swings. And this is a really good example of a chart that had been really strong until it wasn't, right? Now, one thing I look at, one of the key patterns that I look at as a swing trader is a sequence of when I see an uptrend where the whole row bodies, the candles are getting larger. And like Steve would say, that means the bulls are gaining control. When you see the range of the candles are getting higher day after day, that's a buy signal. Now, as an active trader, I'm always looking for kind of like the difference between signal and noise. There's way too much noise out there. Like Marina intelligently, correctly talked about, and I make this mistake myself often because I love trading. It's kind of a discipline issue more than error. But trading inside consolidations, that's where I give back most of my profit from the early morning. How many of you have ever done this? You make money in the morning, like I'm up, like 800, 1,200 bucks in the morning, and then I piss it all away over trading inside lunchtime chopping, even though I know better because I think it may keep running. I used to do that. I do that a lot less now, but I used to do that where I make money in the morning and then I give it back to the market. I donate it back to the market, trading inside consolidation. I'm much better now than I used to be, but it's still a challenge for me, to be honest. I still overtrade because I love trading. It's what I do. I'm a trader. I did over $41 million worth of order flow last year alone. Look at my tax return proof on the front of my site at trademastery.com. That's my 1099 from Fidelity. And it's honest. It's because of course I know the SEC, I'm sure, looks at my site, and that's fine because I'm very honest. I'm straight. I did over $41 million worth of trades last year. So I've got a F-load of experience to share with you guys. And I'm very candid about my screw ups as well as my wins and my victories. It's very difficult to trade. It's something I used to say at the money show events is it's much more about the math than the chart patterns. And that's true. The most important data point on this chart is what? It is not this, it is this. And any professional trader would say, oh yeah, I agree, of course. Professional traders don't even use charts that much. It's more about the numbers, just like Wall Street algorithms, like Oscar was talking about Wall Street. It's all about the numbers. See, if the range here, it's all about range. Extreme range is great. Tiny compressed range is terrible. If this range on this chart was say 12 to 15, it would be a horrible chart and not worth trading, even if the chart pattern looked the same. If the range is compressed, it's not worth trading. This is a wonderful range, 12 to 21. It's almost a double. So that's a beautiful chart. If it's a 50% or higher range, that's great. So that's a very important takeaway. Let me give you another rule of engagement. And that is don't enter inside charts or inside days. And that means whenever a chart is inside the previous day's high-low range, don't ever trade that. For proof of the efficacy of what I'm saying, go back over your last 20 or 30 stop losses. And I won't say guarantee, but I would say probably a large percentage of those were trades that you started that were inside the previous day's range. Now, why does that matter? Well, ask any Wall Street pro. I ask guys like Oscar, I ask anybody who knows what they're talking about. The Wall Street algorithms, the quants program, all the Boolean operators algorithms, Wall Street buys outside ranges. I know a very famous market wizard, and she would say talking about the same thing. Inside days, don't trade when the stock market's inside the previous day's range. Follow that rule, and you'll probably save a bundle. Don't trade. This is very valuable. This is a game changer, a life changer for a trader. It was for me. I've had my most profitable years and months and whatnot, understanding and how to apply this. Don't trade whenever the stock market is inside the previous day's range. Those are inside shit days. Don't trade any stock or Forex or ETF chart when it's inside the previous day's range. That's a shit entry. That's a bad entry. Be like a Wall Street trader. They're HFTs, the high frequency, and I have institutional clients. I know the shit. I used to have market makers come to my live events, so I know what the street does. We trade outside the range. Now, the other trick is avoid false breakouts. Now, how do you do that? Well, you may have seen my stocks and commodities articles. I'm a columnist for technical analysis of stocks and commodities. I have to write an article is overdue. I need to get in soon too by this weekend. But the point is, have a safety buffer. For example, if the previous day's high is $20 a share, you do not buy the instant it gets over 20. That's dumb money entry. Wait till at least 2020 or 2030. Give all entries at least minimum of 20 cents above the previous day's high before entering. That's very specific. That's very actionable. That's very provable. That's very testable. Okay, so remember what I say. Don't buy unless it's at least 20 cents above the previous day's high. That will keep you out of a F-load of trouble. Okay, and don't take my word on it. Test, right? Like Reagan, back when we used to have real presidents. Trust but verify. I say don't trust and verify everything. You always check everything. It's one thing I picked up. I always got to read between the lines or how people evaluate things. And I was really impressed with Oscar's presentation, where he's talking about he doesn't just check one thing like the NASDAQ or whatever. He'll check the transports, he'll check the Dow, the S&P, the Russell. have multiple checks, do a little bit of work. The price of being a successful trader is you do have to do some work. It's not easy, but it can be done. But you have to do a little more thinking than the average person does, because the average person loses and you don't want to lose, right? So I'm giving you a lot of the shortcut tips of things that have helped me make money in my own trade. So does that help so far? So anyway, range is critical. Remember that's a rider downer. As my colleague, the great marketing expert, Dan Kennedy would say, it's a rider downer, something to write down. He's brilliant. Anyway, range is really important. So you want to have a range that is tradable, risk reward wise. Now this has a barely tradable range, 16 to 23. Yeah, it's all right. But over 3 months, I'd like to see a lot more range than that. It's still tradable, though, that barely tradable. Now this is eminently tradable. Reminds me of that song by the great rock band The Who, Eminence Front. Well, anyway, this is eminently tradable. This beautiful hammer down there. It's hammer time. Ba, 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 da, ba. Anyway, it's a hammer that says go long above it. Go north, young man. And the range is beautiful, 6 to 13. It's a doubler. So train yourself. Here's a very quick tip. Train yourself to only trade charts that are at least have a 2 to 1 double, or at least a minimum 50%. So like, let's say the bottom was 10, the high doesn't have to be 20, but it should be pretty close to that. Here's 6 to 13. That's a 2 to 1 ratio. That's good. It's a nice, tight, clean, like my colleague, the great Harry Boxer. He's another brilliant guy you need to learn from. Harry Boxer at www.thetechtrader.com. And Harry, if you're out there, give me a shout out. I'd love to have you back in these events. Thetechtrader.com. Look at it. Get his book, Profitable Day in Swing Trading. Highly recommend. Anyway, Harry likes 45-degree angle breakouts, and so do I. So does anyone who's a professional knows how to trade. That's a really good pattern, 45-degree angle breakouts. And the tighter the range, and the tighter the price action and the bigger the range in a 45-degree angle continuous breakout with increasing volume and more green candles than red, the better the trade setup, right? Now, one of my favorite patterns, and I will share with you, see if I can find it. Now, see, that's a tradable chart. That one's tradable too. Now, not here, not till breaks 840, right? But it's 5 to 8. That's tradable. That's enough range. That's good enough range. Here you go, at 3.5 to 8.5. That's a 2 to 1 range. Now we're currently it's a bearish engulfment, and it would say to sell right under the support here. And we would not buy until it takes out a previous high well over 840. So this is one that, like Bennett had a lot of really good examples too. So many smart traders here. I'm deeply, profoundly grateful to the speakers. What do you guys think? Did I picked some winners, right? The speakers today were good, right? I learned something from each of them, and I always count that as a success. That's something Marina said too, which is a smart point. If there's one good solid point that you took from each of the speakers, it's worthwhile, right? And I think the 30-minute time frame keeps us focused and one good idea. But did you guys like the speakers? What do you think? Give me some feedback. I think they were good myself. I like having, unlike other webinars, the multi-speaker where they have these long-ass hour-long presentations and people that don't know what they're talking about. That kind of sucks. I want to be the opposite. I want to provide good value with top-level speakers with short sound bites, 30-minute segments, so you're not, when's the next person? Like, get on with it. So, wow, a lot of things. Love it. Was this recorded? Yeah, they're great. Thanks. Yes, the speakers are good. Like the speakers and time frame. Yes, we're good in 30 minutes. Good. Okay, thanks. Awesome speakers. Hey, thanks. Hey, Deb. Hey, speakers are great. Very good sessions. Thanks. All right, thanks. We had a winning event. My goal is to get these do one of these for you guys at the last Saturday of every month. And so if at the front of the World's Top Trader site, hey, Art said this has been much better than I thought it would be. Well, thanks, Art. That's I'll appreciate it, man. Daphne saying thanks for your effort to get him to participate. Yeah, it's a thanks. Well, somebody's got to do it, right? There's so much junk out there on YouTube. Don't get me started. There's so much bad information, right? I like my colleague Steve Nissen correctly says, there's like a lot of misinformation out there on candlesticks. Like some of the copycat so-called candlestick experts will say things like, it's a selling doji. And no, it's uncertain. Doji means clumsy in Japanese. Anyway, so Steve has it. Steve Nissen has it right, but a lot of the competitors out there screw. Learning from people that actually know what they're talking. And Larry's comments on the VIX are always brilliant. I always welcome Larry. I'm not an options trader, but I pick up. So he's the top expert that I have on the VIX, right? Or people like Tom Salzman, the smartest guy in the industry. A lot of really sharp people out there. So thanks. Hey, William saying today was Christmas. Come early. Thanks, Will. Hey, Eric saying missed beginning. Could I see replay? Yeah, I'm trying to. It's showing that it's recording. So I'm going to play saxophone in a few minutes, but anyway, let's take a look at some charts. Okay, we'll move on. Thanks. Sounds like we've got a good session. Thank you folks for taking time out of your life to be here. I sincerely appreciate it. You know, my goal is to not be like one of these internet salesmen, hardcore marketers. It's more to be a facilitator of trader success. And I can't answer all the questions myself, and other people that are as bright or brighter than me, like I had today, a really good pickup. I picked up new ideas from each of the speakers. So it's my honor, and thank you very much to the speakers, and thanks to all of you for being here. Need a bass player. I like bass. I play a guitar. I tried playing guitar. It's kind of fun playing electric guitar along with like the Rolling Stones live concerts or whatever. Anyway, towel looks good. Okay, let's move on. Technical pattern, a good setup. This one illustrates it. This way we have a small whole whale body candle in an uptrend that's green, followed by a larger 50% or larger. Like if the previous one was say a unit of 1, the current one should be 1.5, or 1.5, 50% larger. And you can see that pattern here. Increasing volatility on increasing volume at price action new highs is a strong sell, strong buy signal up there. We don't want to sell it. We want to buy this if it gets over, say, the 8 whole number. Another quick tip is thou shalt not buy 9s, right? Do not buy anything with a 9 in it. The 9s are sell targets. So if you buy something at $21 a share, you should really be tightening and trailing stop. 9s are sell areas. The AutoZone illustrates this really good. Outstanding swing trading chart, right? Let me give you another quick tip. Every time you trade, you should look at it as though it were let's say a TV show with 5 episodes, or miniseries with say 5 episodes or whatever. It's a sequence. Every trade decision you make should not be about trying to make money with that single trade. The first trade should just be seen as a first seed that you plant in a garden or something. A sequence of trades. A really brilliant video by, well, anyway, I'll cover that later. The point is, every time you trade, you should look at the first trade as just the first in a sequence or a series of 2 or 3. Now you can reverse martingale in or scale up, like maybe buy 100 shares the first trade. Instead of 500 shares, you just do 100 shares. That's a smart idea. Then if it craps out, it doesn't cost you much. That's really important, because like my most profitable year, I was wrong 72% of the time. 72% of my trades, thousands of trades, were red. There were stops, but I made so much money on the remaining 28%. I was nicely in the green for the year. Okay, even after commissions back in the day. So it doesn't matter what percentage of entries you're correct in. What matters is your net profit, and the way to be successful at doing that is to have every trade cost as small as possible when you're wrong. For example, my day trades, I may do 500 shares at a clip, but I only have like an 8-cent trail stop, so it's only $40. So I'm controlling a nice leverage of 500 shares, but the cost of screwing up is only 40 cents, right? Which is next to nothing. And if it runs, half a point or a point, I made quite a bit of money. So the risk reward numbers are lopsided in my favor. As an active trader, I urge you to figure out how to put the numbers in your favor as an active trader. Okay, and you do that with really tight stops. And like Salzman says, trade small, trade often. That's how any good professional floor trader, experienced trader does that. The math is a lot more important than the chart patterns. So you want to break your trade instead of doing one big trade. It's the big trade because I see a MACD crossover, a VWAP crossover, stochastic, and it's going up. No, the majority of your trades are going to be stop losses for the rest of your life. No one's going to tell you that, but I'll tell you that. I'm the professor of harsh trading reality. The majority of your trades for the rest of your and my life are going to be stops. How do we still make money in that situation? The answer comes from my, unfortunately late, passed away, Van Tharp. Van just recently passed a few months back, but position sizing. Highly recommend you get Van Tharp's books, like Trading Beyond the Matrix and others on position sizing and scaling. It's all about making lopsided entries such that the cost of any one trade being wrong is minimal. Because if you go into it eyes wide open, knowing that you're going to be wrong and take stops on 70, 80%, well, maybe 70% of your trades, you could still make money, but you have to have lopsided wins. You're allowed to take small stops. You're allowed to take small wins and break even trades and medium to large wins. The only kind of stops you're not allowed to take are medium to large stops. For example, I'd much rather have 5 $100 stops than 1 $500 stop. And that's a game changer. These things actually work. They're honest. They're lessons learned from millions of dollars of real money trades I do. So, for example, I mean, I kind of trade like a maniac, right? But you can see, these are some of my trades from yesterday. Okay. And look at the scroll bar. I'm not going to scroll through all these punks, but dozens and dozens of trades. Now that's a little more work than most people are willing to do, and that's fine. But my goal is move towards that more professional approach where you're doing a ladder or a sequence of position size trades rather than all or nothing and you take a big stop when you're wrong. That's how to blow up your account. Please stop doing that. The other thing I will ask you to please stop doing is trading effed up charts that are choppy and stupid. I will, at the risk of, I never attack traders. I'm always on your guys' side in a friendly coaching way. I like to watch NFL. You guys watch the 15-minute highlights reels on YouTube? I watch those daily. They're fun to watch. The great passes and blocks and tackles. And anyway, the point is, you guys hit me up with a couple of charts and I'll tell you what's wrong with them. How do I control my emotions? Brilliant answer or question from William. I use one triggers the other orders so that every single trade I make, most of the time, not lately, but most of the time, I have an automatic trailing or hard stop attached to that trade. So I use one OTO, one triggers the other conditional orders such that, so for example, like if I put a buy, I feel like a buy stop 71.4, trailing stop of 50 cents or something on this chart. So it automatically gets me out without me having to manually make a decision. That made a huge difference in my trades. Trust me, one triggers the other order flow. That way you don't have to manually, and also you don't have to screw up if it starts to run against you sharply and you don't want to scramble and all that kind of stuff. You can just put on a one triggers the other order with an automatic trailing or hard stop. Hey, thanks, traders, and enjoying the webinar. Well, enjoy having you guys be here. Big turnout. I'm going to play saxophone in a few minutes because it's one thing I do. I have nothing to sell you guys. I just join me on Saturdays, my Trading Week Ahead events. The Zoom link is on the front of the website at the top there for trademastery.com. And that should be fun. Let me pull up a couple of charts. You guys give me a couple of tickers. We're almost ready to wrap up here, but let me pick up just a couple of charts and I'll tell you what's wrong with them, or right if you guys have a good chart. Give me a couple of chart picks if you guys would. Still so many of you here. Okay, Apple. Oh, wow. Okay, that's probably enough. Okay, thanks. Apple. Now that's choppy as heck. How would you ever make money trading that chart? I mean, seriously, what is your major malfunction? No, hey, Apple, look at that chop. How in the world could you make money trading that? I mean, I'm serious. How in the world would one, that's an impossible chart. Band. Okay, that's a good chart. Hats off to you for that one. That's from John, I think. That one's tradable. It's got range, it's got strength, it's got trend, it's got a nice tight uptrend. Okay, so band looks great. That gets an A. Apple sucks. That gets an F, right? It's like an eye test. Can I make money with it, or am I going to F up and lose money? Okay, enough, guys. I'm not going to have time to pull up any other charts. I'm sorry. Let's see. Steel Dynamics. Metals are up lately, right? X. I like U.S. Steel. The trend had been good until it wasn't. I wouldn't touch it here until it takes a new high. So another quick tip. What's on the left side of the chart doesn't matter as much as what's on the right side of the chart. So now we've got a trend reversal and a sharp pullback. So this would be a place to not do anything with that chart. Let's see, how about Ford Motor Company? I wonder if it'll ever get back to 23, eh? It's a terrible chart, and we don't want to touch this thing with a 10-foot pole. Let's see, what else? MDB. Nah, the range is just okay for a $200 instrument. I prefer charts like that. So the one thing I want you guys to do is keep a keen eye out for charts that have relatively wide ranges and tight focused approaches or tight focused price action that are easy to trade. They should be easy to spot, right? You're looking for charts that basically are in a 45-degree angle uptrend with a nice tight range, a tight price action, and a relatively tight range. All right, if I can get this set up, I'm going to wrap up here now. I wanted to thank all of you for being here, and I'll stick around and play a little tenor sax for anyone who wants to listen if I can get it set up. But on behalf of the speakers and myself, I wanted to, just a second, I'm trying to get my cell phone Go in here. On behalf of the other speakers and myself, I sincerely wanted to thank you all for taking time out of your busy holiday lives to show up here. And thank you so much. For more on my site, you can visit me at trademastery.com. And I sincerely hope I can help you make bigger winning trades more often and stop screwing up with the bad trades, or at least make the cost of screwing up less than it otherwise would be. So we're trying to keep on top of things. All right, well, thanks for being here. Let me go ahead and stop the recording here.